Hello viewers, welcome back to our YouTube channel. Today we want to continue with our series on advanced financial management, and currently we want to start a new topic that we introduced in our previous video. Of course, I told you that we are going to start on a topic called capital structure and dividend policy. So the topic is capital structure and dividend policy. So we want to start with something to build up with what we covered in the previous video. We agreed that capital structure in the previous videos, we agreed that capital structure is actually a mixture of sources of funds a firm uses. These are mixture of funds a firm uses, and we said it could be debt. And when we talked about debt, we looked at bonds, we looked at bonds or debentures, we looked at term loans, and we also included things to do with preference shares. We say that preference share is debt from the legal point of view. We also said it could be debt or it could be equity. So in a business, you can be using debt, a mixture of both debt and equity items. So with equity, we said it could be common stock. That's what we call OD, ordinary shares. These are ordinary shares. It could be retained earnings. Of course, most of the times these are the two that form what we call the equity. So in your capital structure, or the mixture of different sources, it could be debt or equity. And you may find that in your capital structure, you have all of these items within your capital structure. Now, what we need to understand is the fact that if a company has both debt and equity in its capital structure, so the amount of debt items or debt component that we have in our capital structure, or the amount of debt the firm uses to finance its assets, is what we call leverage, financial leverage. So if we are using debt in your capital structure, we say that there is leverage, or what we call gearing. Gearing and leverage, they mean the same thing. So once in an organization you have debt in your capital structure, then we can say you are geared. Now, if you have a lot of debt, you have a component of debt finance in your capital structure, we say you are geared. Now, the moment that you have a higher debt in your capital structure, then we can conclude that you are highly geared. So once you have more debt in your capital structure than the equity, then we can say you are highly geared. So a company is said to be highly geared if at all their debt outweighs or is greater than the equity, meaning that the debt component outweighs the equity component. So there are arguments as to whether the company should have debt in their capital structure. Others think that it would be fine for a company to have 100% debt to be financed by 100% debt, or to be financed by 100% equity. Others think that we should have a combination of debt and equity in our financial structure. Now, there are different reasons, there are different advantages, there are different disadvantages of you having debt in your capital structure and having, let's say, equity. You can be totally having equity in your capital structure, meaning you don't have any debt. You don't use debt to finance your assets, or you may be 100% using debt. Of course, you can't be 100% using debt, because once you start a business, you can't start a business by just borrowing the money that you are starting with. At least there is something that you must have started with as the owner of the business. Maybe you had a building and you said, okay, let me just borrow money and I use that money to finance the operation, but at least I have the building. So the building will come as an equity or your own personal contribution. So the argument, though, is not as to whether someone should actually have debt in their capital structure or shouldn't. The argument is that the company, if it has more debt, in other words, if the company is highly geared, then it raises some concerns. Of course, we are not saying that the company which is highly geared can't exist. It can exist and it can be performing very well, but it has concerns to do with the takeover, because at some point, if the business fails to pay, then it has a risk of being sold out or taken out by those that gave that business the money. So we need to understand the argument of debt versus equity financing. In other words, for us to be having two things in our capital structure, I know we talked about a little bit about of course, having debt and having everything in your capital structure. We are just going to look at something small briefly, just to loop up what we discussed in the previous videos. But I want us to now concentrate on debt finance versus equity financing. In other words, we are still looking at the arguments of us having both debt and equity in our capital structure, having them at the same time. What is the argument behind it? Would it be good for you to have more debt than equity, or would it be fair for you to have equity more than your debt? So we are kind of taking something to do with kind of comparing what should be the idea. So financing a business through borrowing. Of course, when you are borrowing, that's debt. Financing a business through borrowing is cheaper than using equity. Why am I saying so? Why am I saying that financing a business using borrowing is cheaper? Because of these other reasons that I'm going to give out. Now, one of the reasons is the fact that lenders require a lower rate of return as opposed to ordinary shares. As opposed to ordinary shares. In other words, as opposed to equity finance. Because what do we mean by this? Now, you know that the shareholders, of course, these are the ordinary shareholders. Now, you know that the shareholders will need everything that the company has made. But if you are the lender, you are the bank, if you had suggested that you are going to pay us 10%, it will be 10% even if the company makes 200% profit. It will always be 10% because that's what you agreed to pay as the interest for the money they have used in the production of that income they have earned. But what happens to the side of the shareholders? For the shareholders, whatever the business has made, whether they put in 100 million and now the profit is 1 billion, they will be claiming on the whole 2 billion. But if the lender gave you 100 million and you are supposed to pay 10% or 2% or 10%, whichever the interest rate that you agreed on, and they gave you 100 million. So it would mean that on the 100 million that you paid to them, even if you have made a profit of 1 billion, you will still pay 110 million. You pay the principal plus the interest, if at all you are going to be paying it in 1 year. So that's why it is cheaper for you to finance a business using borrowed money than equity. Because a lender require a lower rate of return as opposed to the shareholders. The other is the fact that the transaction costs of securing debt are always minimal. The transaction cost of securing debt are quite cheap, are quite minimal. They are minimal in a sense that if you go to acquire a loan, what will happen? The banker will tell you that maybe for us, we charge, let's say, 3% processing fee. And they tell you on top of the processing fee, we are going to charge you stamp duty of let's say 50,000 Uganda shillings. And on top of that, we are going to charge you application fee of let's say 20,000. And that's it. But once you go to borrow money from equity, or if you issue out shares to the public, first of all, you have to hire experts. You are not going to do it alone. You will have to get lawyers who are going to be able to draft for you those different documentation that are needed. You are going to get the people, you are going to incur marketing costs, selling, making sure that you get people to know that you are actually issuing out shares so that they can be able to come and buy. There are other processes that you are going to go through for you to actually issue out those shares. So once it is going to be equity, then you are going to be incurring a lot of costs in regards to trying to get equity money. But for loans, the lenders are always straightforward. We charge you 2% or 1% process fee or transaction costs, that you find yourself the costs are very minimal, and it even saving time for you to actually be able to get the money out of it. The other is the fact that the interest is tax deductible. The other point that I can talk about is the fact that interest is a tax deductible. Interest being tax deductible means that the taxman allows you to expense interest as an allowable expense before you charge tax. The whole idea is the fact that you are going to be paying less taxes because of you reducing your profit that you have made for a given period by the interest figure or the interest expense that you have incurred for using borrowed money in the production and supply of those whatever goods or services that you are rendering to your customers, which is not the case as for dividends. Dividends are paid out after getting the profit after tax. That's when dividend is not an expense. It is more like an appropriation of the profit that you have made. So that's why we are saying that borrowing from the lenders or using debt in the capital structure is more cheaper than taking equity. Of course, there are disadvantages that give, like the fact that the other advantage that you can talk about, there is no delusion of control. So delusion of control is the fact that when you bring in shareholders, these shareholders are actually going to come in and they affect how the management is going to run or how things are supposed to be done within the organization. And they do that through their annual general meeting where they can dictate what is supposed to be done. But for the lenders, when they give you money, it's up to you. As long as you can be able to pay them money that they have given to you with their interest, you are good to go. They have no problem with whatever kind of business. They don't interfere in the operations. Whether you invest the money in a very risky area, as long as you can pay them back, they have no problem. But as I said, there are disadvantages of you using debts. One of them, you could talk about the fact that some people may actually fear that their company may be taken out because of, I guess, if you don't pay the interest will keep on accumulating. And once it keeps on accumulating, it can threaten the going concern of the business because you can end up liquidating the business to be able to pay off these people because interest is supposed to be paid. It's not like dividend. For the dividend, you can choose to pay or not to pay, or you can even change and say, I'm going to pay you paper money. Maybe I'm just going to increase your shareholding, but depending on the money that you have made as a business. So that's kind of something that I wanted to reflect on before we go into what we call the capital market theory, the capital structure theories and other kind of stuff. The other thing that I feel it's really important for us to look at it, even if we just give a highlight, are the determinants of the firm's optimal capital structure. When I talk about the word, let me first write it, determinants of the firm's optimal capital structure. Now, when I talk about the optimal, the word optimal means something that is a little bit moderate, something that you see, you can look at it and you say, okay, it's enough. It's not too much, it's not too small. It's in between there. It's just enough. So, what do we mean by the determinants of the firm's optimal capital structure? We want to look at what is that good composition of you having debt and equity. What is the optimal level that I should have, let's say 50% debt and then 50% equity, or I should be having a 40% equity or a 60% debt? What determines, or what factors can we look at and say that based on this we should actually have this, so that we can be able to have or to moderate Because as a business, you don't want to have, as I said, you can't start a business honestly from the money that you have. Everything that you have is borrowed money. Like you don't have anything. Oh, I know you can start it, but especially maybe when don't actually have anything, but it's kind of something that you need to look at, especially when you start operating. You see how quickly can you be able to bring in something that is not equity, because that is not debt, because debt gives higher chances of you losing your business. So want to look at what are those factors that are helping you determine an optimal capital structure. So the optimal here means that the company, you may find that the companies may be trying to balance between debt and equity. So you are trying to have a balance. You don't want to look like you are too into debt or you are too much into equity, because if you have too much money in terms of equity, you may not actually even think of what can I do with the money that I have, because we've seen situations like when we talked about things to do with overcapitalization, things to do with overtrading. We looked at where situations where someone, like especially for overcapitalization, where someone has so much money that, or they have very many assets, but they don't yield. If you look at the profit that they are making, it doesn't yield much. Like they have a lot of resources. It's like when you have very qualified employees, but you look at what they are doing and you'll be like, wait a minute, what are these guys doing basing on their qualifications are okay, but when it comes to maybe in terms of execution or in terms of what they are doing, actually convincing customers maybe to have very many customers on board, it's a problem. So that's, you don't want to have such kind of stuff, and you don't want to be at the extent where you are lacking, completely lacking. You don't want to go into borrow. You are so conservative that you just prefer to use the money that you have. You don't want to go in for debt, fearing that the company may actually go, or you may lose your business. But everything is just about risk. But as long as you take calculated risks, has no problem. And that's why we are trying to balance, to have either to have debt or to have less, depending on the kind of situation. So what are some of the factors? Number one, we can talk about the tax deductibility. These are some points, but the way you phrase them. Tax deductibility of interest. You see, as I told you, interest is a tax deductible. So once it is deductible, someone may use that as an advantage because you are benefiting. If I'm allowed to expense interest, then I'm going to, of course, make myself have debt in my capital structure so that I can expense and I pay less in taxes. But it doesn't necessarily mean that I'm going to actually have so much debt. So it depends on how much you want to save as far as interest being deducted before you charge the tax on the profits that you have made. So if you don't want to have any kind of saving, you know, companies do some tax planning and all other stuffs. So these are some of the ways where you can actually save. If you want to go deep into what we call the tax planning, we have losses. If you look at the different countries give what we call, they give year relief. Of course, you can't pay tax when you're making a loss. And to some countries like Uganda, taxes, those losses can actually be transferred. They can transfer up to 3 years. Of course, you learn that when you do your advanced taxation or taxation paper. But those are some of the kind of things that you look at and you try to plan, because if you are going to have these expenses that are going to be allowed to you as a business, it is a saving to the business. So the tax deductibility of interest. Remember, we say that we are always allowed interest. We are always allowed interest to be expensed before we charge tax. So it's important, and it's one of the reasons why people are going in for debt to actually enjoy that benefit. The other point that we can talk about is what we call financial risks. So people fear risks. Of course, financial risks comes as a result of being geared. So it can determine if the risk is too much, people can say, let me ledgerate. And I don't go into debt, but I use some maybe 50-50. I go, oh, maybe I have 30% debt and 70% equity. So that I know even if I lose this 30%, I can actually still have of course, you get the other 70, you still have the other 70, you pay off the 30%, you remain with the 40% as your capital. So the level of financial risks. So this is just basically the risks that are associated with your capital structure by mere fact of having debt in the capital structure. So and I want to be a little bit flexible, that the way you explain this, the way you give these points, the answers are the same, but the way you explain them, it is just a matter of understanding what you're doing. We saw this number, actually some of these are examinable numbers. Don't take them for granted. We saw May or June, May/June 2022. We saw a question. It was about the factors that influence a company's capital structure. Of course, they are the same determinants that I'm talking about here, though the way you explain them may be a little bit differing, because this is just looking at the optimal. But the other one, the question was basically on the factors that influence a company's capital structure. They don't talk about optimal amount of debt and equity, but for them they just wanted the general thing. But they are the same points. They are the same points that you could give out. The other, of course, we have also these business risks. There are risks associated with just having capital. There are other business risks like operational risks that are going to be associated with. So even the growth of the company can determine, because the growth rate of the company, if my company is all that, maybe, of course, if the company is already a grown-up company, some individuals may prefer to have more of their own money than struggling to be working for people, paying the interest and all that. But if the company is just starting to grow, the level of growth is not all that. You always want to perform. Given the fact that you have debt in your capital structure, you'll find ways of how to make this business grow so that you can be able to pay the loan that you took. So even the management style, you can get the management style. You can get management that is not all that going to go to their extreme. There are people who are just not risk takers at all. If you get those on board, of course, it will have an impact on basically how they are going to determine. I'm mixing these points and I'm answering two questions at the same time, but just try to get where I'm separating the two. If we were talking about the optimal, then we are basically looking at a regulating point of view. But here we are just giving general points, but you can use them and explain to be able to get to what the requirement of the question is all about. Of course, we can talk about like financial flexibility. Financial flexibility. It could be flexible. You may be having debt in your capital structure, but you can convert it. It is maybe a convertible debt. You can actually convert it to equity. So the kind of flexibility of the finance that you have, is it something that you can actually, if maybe you have equity, can it be converted to debt? If you have debt, can it be converted to equity? So the level of flexibility may determine how much debt or equity you are going to have in your capital structure. The other is commitment. Commitment. If you are committed to something, you can actually do it. So that's a little bit self-explanatory. There are also things to do with market conditions. What is prevailing the market? The market may be too harsh that you can't even get debt. It is too expensive, you can't afford it. So you find yourself having more of equity. So you can also talk about the availability of the resource or the present, the available sources. You may want debt, but the debt finance is very expensive for you. The other, you may talk about risk attitude. How are you able to look at the kind of risk? Are you a risk taker, a risk averse, or so? Whichever you are going to impact on whether you are going to be on the kind of structure, the kind of capital structure that you are going to have, or the kind of sources of finance that you are going to have in your capital structure. So that's basically what I wanted us to talk about as far as this first introductory is concerned for our topic on capital structure and dividend policy. In the next video, I want to look at the capital structure theories. Capital structure theories. We want to look at some of the theories. We want to look at what are some of these people are saying. We have the traditional theory of capital structure and others. We want to look at what are these people talking about as far as having debt in the capital structure or equity is concerned. The capital structure theories. And to be very clear, there are only two. There are only two theories. Now, of course, we all know from the world of economics, people come up with theories. People, companies, of course, they come up with different theories. And most so the economics, from the economic point of view, the economics, there are people who have developed theories surrounding whether you should be going in for debt or you should be going in for equity, or you should have it at the same time. So we want to look at what basically did these people talk about, some of them, and what theories did they invent or develop. Of course, as per the examination, for the examination, if they ask you about theories, then you are, of course, I'm going to try and make sure that I explain it in the way the examiner would love you to explain it. So whenever they talk about theories, as far as capital structure theories are concerned, I'm going to try to discuss them, these theories, and I try to explain them the way you should explain them if at all they are being asked by the examiner. But the other thing that you should note is that if you are doing an exam or if in an examination, when they ask you about the assumptions of any theory, assumptions of any theory or model, it can be a theory or it can be a model, theory or model, because it can also be a model that you are required to talk about the assumptions of that model. One key thing that I need you to get from the bottom line, whenever you see any question that is requiring you to talk about the assumptions of any model, when you are giving the assumptions, make sure that you give them as the way they were invented or the way they were developed. You give those assumptions as the way they were given by the person who developed that model or theory. You don't explain anything. You just give it the way it is. You don't explain them. You just state them the way they were stated by the person who brought them. But also, the other thing that I need you to note is the fact that if they ask you about limitations of any theory or model, if they ask you about the limitations, then for these limitations, you just criticize. You just criticize the assumptions. You criticize the assumptions. And this is where you are going to explain. You just criticize the assumptions and that's it. After criticizing the assumption, you can now be able to explain more. Why are you criticizing the assumption? You first stated the assumption that they assume this, but maybe it's unrealistic because of this and this, depending on what is happening. So when they ask you about the limitations, sometimes they may call them challenges of any theory. The point here is you discuss the assumptions by opposing those limitations. For example, we had some questions. There are some numbers. Maybe I can give you some numbers. If you look at question, it was question 4 part B of August 2019. August 2019, the examiner asked that assess the limitations of using Modiglian and Miller M&M model in determining the cost of capital. And he gave it 10 marks. Imagine having 10 marks on a theoretical question. So here you will be giving like 5 points, but you make sure you explain them well. So you state the assumption, criticize it, and give a reason as why you are criticizing. It's not just criticizing and you leave it there. You have to give a reason as to why you are criticizing it, or you are opposing that assumption that as was invented by the person who developed that model. So we need now to understand what are the two theories. I told you that we had two theories in the capital structure theories. So what are they? So what are those two theories? Capital structure theories. One, we have what we call the traditional school of thought. Traditional school theory, or you can call it school of thought, or what we sometimes they call it, they don't call it that, they may call it the traditional theory. The other theory is what we call the M&M. Is what we call the M&M, or what we call the Modiglian. These are people. Modiglian and Miller. That's what we call the M&M model or theory. These are the two that we have. The name is written as Modiglian and Miller. This is a G. Modiglian and Miller. So these are the two theories that we have as well as capital structures are concerned. Now, I want to, basically on these two theories, I want to focus more on the examination purpose, because the theory may be a little bit wide, but we want to look at the focus of the examiner. How is the examiner going to reflect on these two items, on these two theories? Now, the Modigliani and Miller, I prefer to use M and M model, but it refers to Modigliani and Miller. If you look at the Modigliani and Miller, they came about and they found, of course, when you look at these Modigliani and Miller, M and M, they came about and they found that this traditional school of thought, or the traditional theory, they found that it was telling investors or companies or corporate finance on the capital structure. So they had what they were telling, or what they were discussing, or what they were implementing as far as corporate finance or corporations should behave as far as their capital structure is concerned. So in the exam, you will be asked to explain. The examination focus is that, so this is the first one. This was the traditional thought was the first one. Then this Modigliani and Miller, they came to just try to they tried to sort the mess that was brought by, maybe I can't say it was a mess, but they came to resolve what was not served by, depending on, because time keeps on changing and even things keeps on changing. So once there are some new developments that have been come into existence, of course, different economists come up with something new to add to what was existing. So the examiner will tell you to explain the theory. Then we also look at the assumptions of each. Then we also look at the limitations of each. And also we can also talk about the relevances if possible. Relevances, those are the applicability. Is it applicable in some way or the other? Is it what is prevailing in the market at the moment? Therefore, you need to get the argument of the traditional school of thought or the traditional theory on the capital structure, and they are the same. They are the same things that we are going to use under dividend policy. So I don't actually know whether I may confuse you, but you have to pick the argument very well from at least the capital market structures or the capital structures. Then by the time we go to the other side, that's why the topic is actually capital markets and dividend policy, because we use the same, the theories that we use, they are the same, they cut across. So we use the same theory to explain even what? Dividends. Because per se, if you're talking about, dividends, we know it is all about looking at the equity component. So here we are looking at capital structure. We are looking at those sources themselves. So we shall be using the same, we shall see what they are talking about in regards to debt and equity. Then we'll do analysis basing on whether the company should have more of debt or equity, because that's basically what we are trying to look at. Should the company have an optimal level of debt over equity? So whether the company should have no limitations or no restrictions on whether they should employ debt or equity there, capital structure. Then when we go to the other side, we shall look at if they are saying, if one of them is saying you take more debt, then it means you don't pay dividends. What are they saying basing on those two kind of scenarios? So that's what the examiner is also going to be interested in knowing, but you should understand what the theory is all about. So what I'm going to do, I'm going to start looking at the traditional school of thought. When we are done with the traditional school of thought, we shall look at the Modiglian and Miller. But that is going to be in the next video. This video is going to be wind up to, it has given us an insight of what we are going to be looking at. The two theories that we have, and these two theories that we talked about are the traditional theory and then the Modiglian and Miller. And I had promised that we are going to kick off by looking at the traditional theory of capital structure, and that's what we are going to look at. So the traditional theory of capital structure. Now, if we look at the traditional theory of capital structure, the issue is all about the work. That is what we call the overall cost of capital. Overall cost of capital. The overall cost of capital of any company, or basically what we call the cost of capital. Because work is the weighted average cost of capital. So it comes from these words. W is this, A is this, C is this, then the last C. So how do we come to get this an understanding? I want to be a little bit as brief, as detailed as possible, brief but very detailed as possible, so that you can be able to understand. It is very easy for you to understand it. Now, you know that in the business, this work, we compute it this work, or the cost of capital, is the one that we use to appraise investment projects. So once we use this work to appraise investment projects, especially when we are using these discounted or non-discounted cash flow techniques, as we shall look at them when we do the NPV, the investment decision question. Now, how does it come about, or how best can you explain the traditional theory of capital structure? Now, this is very simple. So, if, of course, you know, when you are doing business valuation, you know that the value of a business or a company, of course, we are looking at valuing the company. Once you are valuing the company, we all know that when you're valuing the company, the value of the company is the present value of its future cash flows. Present value of future cash flows. And when we talk about the present value of future cash flows, we are simply saying you get the discount factor, you get the cash flows that you expect to receive from a given project for the very many years. Then you discount it using the cost of capital, which we call the work. So we are discounting. The process we go through is what we call discounting. We discount these cash flows. Using work. That's the one that we use to discount these cash flows, or what we call the cost of capital. Now, how are we going to do it basically? Now, what happens is that since we are going to be using our work to discount the cash flows that we expect to receive from that investment that we are making, because when you are making an investment, you expect to be getting some money back. Maybe this year you may get 10 million. If you construct a building and it's a residential, maybe then you rent it out to tenants, you expect to be getting cash flows. That money that you are expecting to be getting is what we call the cash flow. So for us to know how much that business or that building is, we need to first discount the cash flows that you are getting from that building. Then we can know the value of that asset or of that building. That's how even what we do with business valuation. We discount the cash flows that we expect to receive for the different investment projects that we did. Then when we are done, we can be able to know the value of this company. Now, what happens if at all you increase the debt? Because remember, for you to compute work, you need to have the different sources that will come together for you to be able to get the cost of capital, the overall cost of capital. That is the cost of using all the sources that you are using in financing those investment projects. Now, what happens? Because within the work we have both debt and equity. So what is going to happen is that if you increase debt, what happens if at all you increase? If let's say you decrease, let's start with the fact that we want maybe to increase debt in our capital structure. What will happen? Now, when you increase debt, then this means that this work, the weighted average cost of capital, of course, it will mathematically go up. Mathematically, it will go up. The reason as why it is going to be increasing is because we have increased more debt. And once this work increases, of course, once we increase debt, then even the work is also going to increase. Now, what is the impact? Once this work goes up, then the overall cash flows, because it is this work that we are going to be using to evaluate the cash flows, then the cash flows, the overall cash flows will decrease. It will causing cash flows to decrease. They will decrease. Why? Or what happens? This, we are talking about it mathematically. Now, this is what happens. The overall cash flow will decrease because, look, when we are getting the present value, we know that when you are getting the present value, we always get the future value divided by 1 plus r to the power of n. Or the other, you may use future value into 1 plus r to the power of negative n, whichever way. But me, I prefer this. I prefer the first one. Now, what is going to happen is that we are getting the present, these are the cash flows. Now, we are getting these cash flows and we divide, this is the numerator, we divide the numerator by, of course, this is R, is what we call the work, the weighted average cost of capital, or the cost of capital, or the required rate of return of the business. So once this work has increased, it means the implication mathematically, it is going to be like this numerator is going to be divided by a bigger numerator. If let's say our work was, let's say 10%, but now we go ahead and we increase our work to maybe 20%. What is going to happen is that this work has increased. If let's say we had the cash flows, we were expecting cash flows of 10 million every year fixed. 10 million. What is going to happen? The amount you are going to have here will not be the same as the amount you are going to have here. So what is going to happen? If you put in your calculator and you just compute it in just 1 year, you just look at what will be the present value for just 1 year. So what is going to happen is that this is going to be 10 million divided by 1 plus 0.1 to the power of 1. So it is going to be 10 million divided by 1.1. So this is going to give you 909, of course 909. If you round off, it's going to give you 9 million. Now, what will happen if at all we increase this rate to 20%? So it will give you 10 million over 1.2. So I think that this denominator is now increasing. So what is going to happen? It is going to reduce the overall cash flow. It will be the 10 million divided by the 1.2, and this is going to give you 8.333. So this is what we are meaning. This is 8.3, this is 9.09. So the overall cash flow is going to reduce. And once the overall cash flow is reducing, remember we said this is now the present value. Once the present value has reduced, automatically the value of the business is also going to reduce. But what caused that? It was from the fact that you increased the debt in your capital structure, and that increasing debt resulted into an increase in the cost of capital. And once the cost of capital increased, it has automatically led to a lower overall cash flow that we are going to use, because these are the cash flows that we are going to sum up to know the value of the business. So automatically it will result into a reduction in the value of the company or of that asset. So that's one argument. And that's basically what these traditionalists are thinking. That's their thinking. Now, because we are going to be having cash flows going down, the resultant cash flow going down, because of us dividing the numerator, we divided it by with a bigger denominator. The result will be a lower. So once the value of the cash flows have reduced, even the value of the business is going to decrease. And that's how the traditionalists are thinking. Now, if you try to reduce, now if at all you try to reduce your debt in the capital structure, automatically it will, even the work will go down. The work will decrease. And once the work decreases, then what is the resultant figure? What is going to happen is that we are going to have the overall cash flow is going to increase. The reason as why the overall cash flow is increasing is because we are dividing a numerator by a lower denominator, and that causes the business to actually have a higher cash flow, the resultant cash flow. And once the resultant cash flow is higher, then it is also going to automatically increase the value of the business. So this, look, the present value, we say that the present value equal to future cash flow over the future value divided by 1 plus R to the power, let's say per power n, but we are just going to basically look at 1 year, year 1 alone. So if we have the 10 million divided by, if the work, maybe our work was, let's say 10%, and we try to reduce the work, we reduce the work now to 5%, what will happen? What will be the end result? This one is going to be 10 divided by 1.1. Of course, this one is going to give us to the power of 1. So this one is going to give us 9.0909. So this is 9.09. So what is going to happen is the fact that here we are going to have, if you try to divide this other one, when you have reduced, it will be 10 million divided by 1.05, because this is 5% when you are using the other 5%. So it is going to be the 10 million divided by 1.05. This is going to give you 9.5. Are you seeing that the overall value is reducing? 809. So the overall value for the overall cash flow is going to be increasing. And once the overall cash flow, the present value has increased, it means it has also increased the value of the business, or the value of that asset you are trying to value. I hope you are getting my argument. So what are they meaning? They are meaning that for you to reduce debt in your capital structure, it's going to automatically reduce what we call the work of the company. And once the work has reduced, it will result into a higher value of the business, because you are going to be having a higher cash flow that you are going to sum up to get the total value of the business. Now, of course, once the value of the business goes up, even the shareholders are going to be happy. They are going to be happy because they are going to be receiving more money on their, even the share price is going to increase because of an increase in the value of the business. So the overall result is going to be the shareholders are going to be happy. And they are happy because you have reduced debt in your capital structure. Now, for them, in their thinking about all this kind of capital structure issue, for them, their issue is for you to have what we call a balance. You need to balance off between debt and equity. In other words, you need to trade off between debt and equity. And that's why their theory is summarized in a very brief way. For them, what they are saying is that for the traditional theory basically says, it states that work must be minimized. Work is minimized. In other words, don't keep on borrowing, because you need to minimize the work such that the value of the company, or the market value of the company's assets, will be maximized. So work must be minimized so that they can maximize the value of the business. And for you to minimize work, you must reduce debt. You must regulate your debt. So if you minimize work through little debt, like having little debt portion in your capital structure, then you are going to be able to give the shareholders a good return on their investment, because the value of the business will actually go up and they will have more to get for the money that they have invested in their business. Now, the traditional theory of capital structure continues to say that for any business or for any investment, there must be what we call an optimal level or optimal mix. They call it mix of debt and equity. We must have an optimal level of debt and equity. In other words, we should have a balance between the two sources of finance, the debt and the equity finance sources. Therefore, you will be able to minimize your work, and eventually the value of the company will be able to increase or will be maximized. So we don't simply We don't simply invest to make money for the debt holders, but we need to make money for our very own company. And for you to be able to make money for your own company, you need to minimize debt. So the traditionalists, they conclude by saying that the optimal capital structure will occur, it will only occur when there, or where we have, it will occur where we have the marginal cost of debt being equal to the marginal cost of equity. In other words, they are looking at a situation that for you to obtain this optimal level, you must maximize, you must be able to see that the marginal cost of debt, in other words, the cost of getting more debt should be equal to, it should be equal to that of the marginal cost of getting an additional cost of equity. So marginal cost of equity should be equaling to the marginal cost of debt. So the word marginal in this argument means additional. If you look at marginal, or it means additional, something that you are going to add on. It is an additional cost. It can be the additional cost of debt or the additional cost of equity. Therefore, at that point, there will be in what we call, there will be an equilibrium. There will be an equilibrium, and work will be minimized. And when work is minimized, therefore the market value of the company will also be maximized. So if the traditionalists, for them, they conclude that if you want to really have a lot of money in the business, you should minimize the debt so that work has been minimized too, so that you can be able to get a higher figure for the value of the business. Therefore, this theory depends on the assumption that imply that the cost of either debt or equity that you are going to use in financing the business will vary with respect to the degree of leverage, or what we call gearing. Therefore, it looks at the assumption that will help you get the max. We have different assumptions, but now I feel like that I should try, because I've been a little bit mathematical when I'm trying to explain. But if you want to illustrate it graphically, we can have some small tip on how we can illustrate graphically. We get a detailed, you can use, if you don't want to go the other way around, you can go this way around, which is a little bit theoretical, and you'll find yourself drawing some graph. Now, for better explanation of the traditional theory, it is better for you to use a graph to explain it. If you don't understand the other mathematical point of view, it's better for you to explain it with a graph, where you'll first draw the graph, and of course on the horizontal, of course this, let's assume that's our graph. Then on the horizontal, of course on the horizontal we are going to have, we are going to have the level of gearing. Then on the vertical, of course on the vertical we are going to have the cost of capital. Cost of the capital, let me just call it work. Now, so that's how we are going to be able to draw this. Now, as you have heard from the explanation that I've made, what you need to do, you need to minimize work. In order for you to minimize work, you will need to reduce debt. By reducing debt, it will result into maximizing the value of the company. And in order for you to be able to have that higher value of the business, as I said, the first thing you do, you have to minimize to minimize work, and at the same time you minimize the level of debt. So the level of debt must be minimized at the optimal level. At the optimal, meaning it shouldn't be lower, it shouldn't be higher, at the optimal. So they are saying that as you keep on borrowing, the cost of equity will keep on rising. So this percentage will actually be a percentage of work or cost of capital. This is in a percentage. It will be in a percentage form. Now, this is how the graph is going to look like. We can start from some point. Maybe we take it that way. Then we draw something that is a bit going down like that. Now, we shall have what we call the minimum point here. This is the optimal gearing. Optimal gearing, whereby you are not all that geared and you are not all that. So this is the equilibrium. This is the equilibrium point or the optimal point. So once you go this side, you are increasing. So here we are increasing work. It will be an increase in work. Of course, this is a work line. This one is a work line. And this one is the cost of equity. This is cost of equity. Cost of equity. So once you keep on increasing this, of course here we try to minimize by moving downwards. So this is, here we are minimizing. By moving down, we are trying to minimize work to the optimal point. Of course, this is now the optimal point. So I want to explain. Now, the whole portion, for sure, for debt, the one for debt, we want to keep it lower. We want to keep it below. So we can keep it maybe somewhere here to be a little bit constant. And we say this is our debt. So this is the debt, the cost of debt. This is equity. So it is going to be from this point, then from here. Now, remember these are percentages. What we are trying to do is we are trying to make sure. So once the other thing that I need you to note is this point here we have the minimum. So once you go this side, you are going to be highly geared. And the moment you keep going this side, you are not going to be geared. So once you proceed to this side, you are increasing. Remember, at this point here, we have our optimal rate. Work has been fixed to this point. But the moment you keep on adjusting and you add in, maybe you try to increase, you are moving out from the optimal level, you will see that even the percentage will keep on increasing. The more you do that, it will keep on increasing. And that's what we don't want. So that's why we are saying we are interested in us minimizing, moving a little bit, we reduce debt to a certain point here. That is the equilibrium point or the optimal point. And at this point, we expect that at this rate, the work is going to be reduced. Because by reducing debt here, you are lowering the work to this point. It was here, but you are lowering it to that point. That means that you are going to be having a lot of debt. So you are going to be having, the debt will be reduced because it will be down below. We keep it. Of course, this one you can ignore it, or you can just put it if you want. But that's how the graph will be looking like. Now, so in order for us to be able to minimize work, the level of debt must be reduced to the optimal point. So the whole of this line here that you are seeing is going to be our debt. Now, once you reduce the level of debt to the minimum point, so what we are saying is that as you keep on borrowing, the cost of equity will keep on increasing. For you, the more you keep on borrowing like this, the cost of equity for it is going to be increasing, as you are seeing. It's a little bit constant. Now, so what we do, we start to reduce debt downwards. So as you borrow, you'll be like, you'll keep on paying interest on debt, and the owners, of course, they are going to be demanding more because you are paying the other side, and for them you are not paying them, because interest is going to be paid whether you want it or you don't want, even if you don't make profit. So as you keep on borrowing, the cost of equity keeps on going up. But the work, of course, the work will of course initially drops. It will drop to a certain point as the level of debt has also increased beyond that point. And finally, the work will be going up, meaning that the value of the company will be also reducing. So the traditionalists are just proposing that to balance between the two, we have to have an optimal level of gearing. And those are the things that I was trying to explain in the first mathematical approach that I used. So what is the implication? Maybe before we look at the implication, let's first just give out the assumptions, just stating the assumptions. The assumptions, of course, we have, they assume that the company will pay all its earnings as dividends. The company will pay all its earnings as dividends. They also assume that the gearing of the company can be changed immediately by of course using debt to repurchase the shares, or by increasing the shares to repurchase debt. Once you increase the shares, you buy off the other people. You get more shares, then you pay off your loan. It's like you are repurchasing the debt. Therefore, that you will not have something to do with the transaction costs. They are also assuming that the earnings of the company are expected to remain constant in perpetuity, and that all investors share the same expectation about the future earnings, which is not the case. They are also saying that the business risks are constant, regardless of how the company investment or the company investors are, or investment and its fund. They are also ignoring the aspects of taxation. So we have no taxation. They are saying business risks are constant, and others. So we now want to look at what is the implication of this. Implications, depending on the graph that we drew. So since a company is going to always wish to be borrowing cheaper. So since the company is going to be wishing to borrow in the cheapest way possible, then it should raise debt finance until it achieves the optimal level of gearing. So for them, they are worried that we don't keep on borrowing and borrowing, and you should borrow up to a certain point, and beyond that, it will be a problem to the business. So we are looking at the Modiglian and Miller. The Modiglian and Miller. That is the M&M model. So we looked at the traditional approach, and we recognize the fact that the traditional approach allows us to borrow up to a certain point, which is the optimal point. It says that we borrow up to a certain point, and that certain point was actually the minimum point, so that we can be able, we reduce debt to a minimum point so that we can be able to reduce eventually the work. And once we reduce the work, then eventually it will be able to increase the cash flow that we are going to be receiving. Because once we discount with a lower discount factor, which is our work or the cost of capital, it's going to give us a result that is a bit higher, and that will increase the value of the business. But now, when you look at Modiglian and Miller or M&M model, we want to look at how did these people react on the capital structure. Now, Modiglian and Miller, M&M says, for them they say, M&M says, they says that we borrow more, as like we borrow more. For them, their idea is just for us to borrow more and more. In other words, their argument is that they want companies to borrow more as they can, so that they can have a higher debt than equity. So the difference between these two modules is that the other traditional theory, it tells us that we should borrow up to a certain point. But this one, the M&M model tells us we borrow until we can see that we can't borrow anymore. We borrow more as we can. So the difference between these two capital structures is that the M&M tells us to borrow more, the other one tells us to borrow up to a certain point. In other words, this one is like they are telling us, because remember we said when we are computing the financial leverage, we said that the company is going to be highly geared if at all it has gone to 100%. So these guys, they are like telling us you borrow up to 99.9%. If they can give you money up to 99%, you borrow. Then you leave the other 0.1 to be equity. So this will be debt. So they want you to have 99.9% debt. Then the other 0. Of course, as I said, you can't have 100% debt, because we expect that by the time the owner starts up a business, maybe you have a land that you are going to maybe to use to construct whatever business you are going to be doing. So M&M tells us to borrow up to 99.9, meaning we borrow as much as we can. So what this model is talking about, for it did a lot of work on the effect of financial structure of a company on the cost of capital. For it, they did their analysis, and they found that there is no such a relationship between you borrowing or between you having debt and equity in your capital structure on the cost of equity, on the cost of capital, or on the work that we are going to use. So M and M did not agree with the traditional theory view. So the traditional view, the traditionalists were saying you borrow up to a certain point, but these guys, they are saying borrow as more as you can as a business. So they argue that in a perfect, for them, they argue that in a perfect capital market without taxation, in a perfect market without taxation, of course, for them, they look at it in a sense that, because the other theory tells us that there is no taxation, there is no transaction costs. You see? But here they are telling you that if you are to have a perfect capital market without taxation and transaction costs, a firm, in other words, a firm's market value and the cost of capital will remain constant. That's the argument. That if you expect the capital markets to be perfect without anything to do with the taxation, without transaction costs, all those are kept constant, then a firm's market value can never be affected by the, in other words, the firm's market value and the cost of capital will never change. They will remain constant. In other words, the company's value cannot be affected by the cost of capital, whether it has gone up or it has gone down. So for them, they are saying that the company's market value and the cost of capital will remain invariant to the changes in the capital structure, and also the value of the firm will not be affected. That's their argument. And M, for them, they produced a formula. They have a formula. They produced a formula expressing how the cost of the cost of equity, the work, and also the total market of the company are affected by the level of gearing. So they add their own formula. So for them, they are saying that has no problem, and they expressed that in a formula to see how the cost of capital, the cost of equity, and then the company's market value can be affected by the level of gearing. So this is the formula, M and M formula. Of course, we have KE. This M and M formula is actually going to help us to compute what we call work. So, but they gave it is in bits. So they have given us KE, of course, KEG, meaning equity and debt. There is some gearing, equal to KEU, KEG equals KEU plus, we open bracket, a bigger bracket, KEU minus KD, we close this bigger bracket, then we open another one, VD into 1 minus tax rate over VE. That is the formula they gave, where, of course, where KEG is equaling to the cost of equity of a geared company. In other words, we are looking at the cost of a geared company, cost of equity of a geared company. Then KEU is the cost of equity of an ungeared company. ungeared company. Ungeared company. Then they are telling us that VD, of course, we know VE and VD. VE and VD, those are the market values. Market values of debt and equity. Debt and equity. Market value of debt and equity. Then the KD is what we call the pre-tax cost of debt. Then, of course, the last T, of course, our T, we know it is the tax rate. The tax rate or the rate of tax. So this is the formula for them. They are saying we can use to be able to determine the cost of capital, what we call the work. So they use what we call the cost of equity for a geared company. So cost of equity of a geared company is like, it's more of a company. They are trying to look at the cost of equity when that company has a debt in its capital structure. That is the meaning. Then this KEU is the cost of equity of an geared company. In other words, we are looking at the cost of equity for that company that is not having any debt in its capital structure. So that's the formula that they gave out. So if you try to look at this, for them, they are concluding that if you want to get your work, they also gave us work, the formula for computing work. They told us work will be equaling to the KEU into 1 minus, we open another bracket. This is VD. Let me just call it VDT, small t, over VE plus VD. So that's the formula. So that's the formula you will see on, of course, if you check this formula will actually be, if this one and the other one will actually be on, this one we may not talk about it so much, but I'm just going to explain something small. So this one I'm not going to talk about it much because we already have a formula that we can use. But what I want to talk about more is the other first one that I gave. Now, of course, if you look at the question paper at the other side, they write it as, for them they use it as, I've just used the different letters, but for now, I just want to to illustrate how it is shown on the other exam past paper numbers in the other formula sheet. So for them, they write it a little bit differently, but it means the same thing. So for them, they are saying KE, which equals to KE, then they put an I here, plus 1 minus T, capital T, into KE I minus KD, then we close the, once you close the bracket, then they put VD. Of course, this one they use small d, VD and over VE. This formula and this one, they mean the same thing. It's only that this one has been arranged, because now if you know mathematics very well, you can actually take out all this issue here and you'll be able to come up to this formula here, because there is a t here. This is the small t. This t will come, remember this one is multiplying inside, so you take out, when it comes inside, the implication, okay, let me just do it a little bit here just to illustrate. So you just have the KEU into, of course I'm going to multiply, this one will be 1, I multiply through, it is going to be, this is going to be I'm going to take out, let me take out this. I take out 1 minus t. When I take out 1 minus t and it becomes in the bracket, what has remained inside it will be, it is going to be actually vd over ve plus vd. But I need to remove, this is vd and this one is also vd. I can take out, I can decide to, of course, say, remember this one is in a bracket, or the other option would be you first get this one over 1. This is just making the other one the subject. You make this one, you take this one to be the whole, the one that is going to be the denominator. Then of course this one will come up here. This, if you do that, it will leave you, this item will actually be alone. If you cross multiply these ones, of course this one you divide by, it will remain with this will divide by this and it will go up. So you remove the v, the d. Of course this one will have the same as like the one here. It will be ve plus vd, like that, minus vd t over ve plus vd. So when I decide to take out, I chose to take out this t. Let me do it up down here. So when I try to take out 1 minus t, then what has remained there will be 1 minus vd over ve plus vd. That is the math that I've been talking about. This is a d. So by the time you roll around this very value will actually take you back to this. But what I want you to get is not how we derive at this, but just know that they are the same, because it is going to chop a little bit more time trying to. What I wanted to show you is that on the formula sheet it looks like this. And now, of course, this KE, for them the KE is the one that I'm calling KEG, this one. Then the KEI is the one that I call the KEU. They have just changed the letters, but they mean the same thing. So that's it. So if let's say we have a simulation, because someone is going to be wondering, how can I be able to do such a number? Now, when we are doing a simulation, we are going to make sure that we say that, of course, in the question they will bring issues. They can say the company that is ungeared. It means that that company is going to be using debt. Sorry, it's not going to be using debt in its capital structure, but it's completely going to be using what we call equity in its capital structure. So the formula that we are seeing here, it helps us to compute the cost of equity. Remember, when you are getting the work, there is an adjustment for that KE, the cost of equity. So we are going to do a simple simulation to help ourselves understand this kind of, how can I be able to of course go through this kind of analysis, and I be able to have, we are going to have a number. But before we do that, maybe let's first look at the weaknesses. What are the weaknesses of this model? Weaknesses of M&M theory, Modiglian and Miller theory. What are the weaknesses? So number one, the risks for the investor may differ. There is that kind of difference in risks, risky acceptance. You may find some of these people, they may not. You find those that are going to say that risks that are going to be in a geared company, and there are those, of course, the risks, the difference in the risk that I'm talking about, it is in the sense that the investors may differ between personal, they may have that kind of personal gearing and then corporational gearing. They may look at it as a little bit something that is different. So the risks for the investor may differ between personal gearing and then corporational gearing or corporate gearing. There is a difference between you, the person, obtaining the money because you got maybe the money that you are going to invest in the business. Maybe you got it from loan, but there is when the company itself will actually pick the money from, because the loan that you have picked me as the owner is not going to be on the company, it's going to be on me. So it is going to create that kind of difference, that I may pick a personal, it could be a personal gearing where I picked money on my behalf. But there is when the corporation itself, the company is the one picking the loan. So there is some kind of risk being differing from whether it is a personal gearing or it's a corporate gearing. So the other is the cost of borrowing. The cost of borrowing for an individual. The cost of borrowing for an individual is likely to be a little bit higher as compared to the cost of borrowing for a company. But when you look at M&M assumes that the cost is the same. In other words, the cost for personal borrowers and then the corporate borrowers, it assumes that it is the same, which is a weakness. Remember, whenever we are talking about the weaknesses, it's like we are talking about the limitations of the model. So these limitations, they are the ones that we are trying to criticize. We are criticizing the model's assumptions. So for them, they are saying that the cost of borrowing is more or less the same, whether you are going in for personal, which is totally different. When you go to these banks, if you are borrowing as a person, they charge you a completely different interest from what they are charging corporations, because you can't have the same assets, like the securities that you are going to put there for you to be able to access a relatively lower or cheaper source. Because when you're going in as a person, it is always risky for them to give you the money. There is a very big difference. Me to give you, the risk between giving someone as in a person is higher than actually giving a corporation, because for the company, even if the owner dies, it will remain there. But if I die with your money, it has also gone. So there is a risk, that there is that difference in the risk, and at the same time, even the cost of borrowing will not be the same. The other, they are talking about the transaction costs. Transaction costs. Of course, transaction cost will restrict the arbitrage process. Now, arbitrage process is like switching. You are trying to switch. That kind of switching involves buying and selling of the same securities in different markets until the market price is in equilibrium, such that the person who's actually doing that process can be able to take a riskless effort. Because since we are going to be buying, the other company is going to be buy and sell, you buy and they sell, but there is, if the market is not a little bit maybe fixed, if the market situation is up and down, you can't, it is going to disturb the process of actually buying and selling those shares. And that's how it is, because the price can't be in equilibrium. It can't be like it is constant, the market price for the shares. Of course, M&M also ignores taxation. It ignores taxation and even the tax implication. Of course, when you ignore tax, even its implication, you have ignored it. And this is a very serious problem, because one of the key advantages of debt is that tax relief on debt, like on interest payment. Once you pay tax, once you borrow money and you are paying interest, you have that tax saving for you, given the fact that you expense interest before you charge the tax. So all that implication, the model ignored it. Also, in practice, it may be a little bit impossible to identify firms with identical business risks and operating characteristics. It will be very hard. Even the companies that are within the same industry, they may differ. Maybe they may differ in terms of the capital. They may differ in terms of the number of customers they have. There's always that kind of difference. So it's not always the same as the model is trying to look at it. The other is the fact that some earnings may be retained, which is also against the model, because once you are going to be retaining the earnings you have made, all the profits that you have made, so the simplification assumption of paying out all the earnings as dividend won't apply for sure, because because for them they are assuming that all the money is going to be paid out in dividends. All the investors are expecting to receive dividends, but not necessarily that all the money that has been generated is going to be given out in dividends. Some money is going to be retained in the business. The other, they also trying to say that the investors are rational. So investors, the model tries to assume that the investors are going to be, they assume to act rationally, which may not be the case, of course, in practice. So the other thing is the fact that under the M&M model, risk is measured entirely by variability of cash flows, ignoring the possibility that cash flows may cease because of bankruptcy. Because once the company can't be able to pay, then that assumption is not going to be valid, especially when we have very higher levels of gearing. Then the other is the fact that the corporate borrowing doesn't expose the investors to personal liability. Remember, we have that limited liability, that you are going to be only limited to the amount of share capital that you have not yet paid. But once the company doesn't actually have the money to pay off its creditors, then you as the owner, you are not supposed to go beyond the share contribution that you are supposed to provide to the entity in case of any kind of bankruptcy or insolvency. So it's also going to be a little bit creating a variation, which is not the case with personal borrowing, because what personal borrowing does, you sell whatever you have to pay people's money. That's it. So that's basically what I wanted us to look at. So if you look at the implication of of that. And also the implication, we looked at the implication of the other traditional theory, and we said that once the company has reached its optimal level, it should maintain that level of gearing. So if it has reached, let's say 50%, let's say if it is a country and it has reached maybe 50% of its GDP, and that is maybe the threshold according to IMF and World Bank, what they tell, then we shouldn't allow them to exceed that. So they should maintain that threshold. Even in borrowing, when you go to the bank, they actually tell you, they ask you to see how much you earn, so that they can see how much are you affordable, because the regulator, Bank of Uganda, says you shouldn't exceed 50% of someone who's net pay. But of course, for civil servants, of course, you know what happens. You can be having a loan in your mother bank, they have deducted maybe 50% of your net. And then you also go to a microfinance, because we have different tiers and they are all regulated differently. Commercial banks are going to be regulated by Bank of Uganda, but you can actually come to microfinance and they give you money. So for them, they will be like, no, for us, we shall just take 48% of your gross. Then after getting that figure, they will take off, of course, they will take off the statutory deductions, like the pay as you earn, that is the tax. Then also NSS if it is there, local service tax if it is there. Then what has been left, they will also chop that. But for them, they will use the other single code. That kind of, because there are two ways. You can deduct money directly, or it can be through standing orders, or it can be through coding, payroll system. So it has that kind of threshold. So that's basically what I wanted to talk about as far as Modular and Mira is concerned. We are now going to look at a simulation under Modular and Mira, so that we can be able to see how we can execute that formula that we saw. So simulation 3, we need to write this question down. It says ABC Limited. ABC Limited is an ungeared company. Is an ungeared company. Is ungeared company with a cost of equity. Is an ungeared company with a cost of equity of 15%. Full stop. They proposed raising debt. They proposed raising debt at 8% pre-tax. In a bracket, we have pre-tax, and have estimated that the resulting gearing ratio in bracket, we have debt to equity. Debt to equity will be 0.4. Full stop. The rate, they are quoting that the rate of tax is 30%. Then they give us the required. The required has some good parts that we need to do. Of course, they wanted us to calculate the cost of equity after raising debt. Part B, this is part A. They want us to calculate the cost of equity after raising the debt. Then part B, of course, they want us to calculate the weighted average cost of capital. calculate the work before. Of course, they want the work before and after raising date. So let's now look at the solution, how we can best do this number. It will help us to get to know what we are going in. Now, you need to be a little bit careful when you are dealing with such numbers, because one thing you have to know is the fact that whether that company is geared or it's not geared. You need to know. So when the company is ungeared, it means that it has no debt in its capital structure. So remember, as I told you for the examiner, I told you last time that the examiner will not ask you to calculate maybe work. The examiner will just tell you to compute the appropriate cost of capital, because here we can compute so many different types of cost of capital, of weighted average cost of capital. Like they can tell you to compute the appropriate cost of capital. Now, when they give you the company is not geared, what do you expect the appropriate cost of capital will be? It will be the cost of equity for an ungeared company. So we need to be careful to see whether the company is geared or it's not geared. So when they want to get geared, because now what we are seeing from this, they are saying that ABC is an ungeared company, meaning it doesn't have, this same company doesn't have any equity. Sorry, it doesn't have any debt in its capital structure. It's ungeared company with a cost of capital of 15%. They have given us the cost of capital for ungeared company. But they are telling us they want to get, because they continue to say that they proposed raising debt at 8% pre-tax. Now, when they wanted to get geared, in other words, to have debt in their capital structure, they can have that as the cost of borrowing. It can either be a pre-tax, meaning that it's before adjusting. Pre-tax means it is before adjusting for tax. And once they get geared, we need to know the proportion of debt to equity. It is very important. Those are the different key things you need to note. Whether the company is geared. Two, we need to know if at all they are trying to get to be a little bit, to be geared. What is the rate? The rate, are they using pre-tax or after tax? After that, then you need to know, after getting geared, what is the composition of debt to equity? Has it changed? It's something that we are going to discuss more. There is a topic that we are going to meet, and we will be a little bit trying to understand, but I want you to get the concepts early. Now, part A, if you look at part A, the cost of course, the cost of equity after raising the debt is the one they are looking at. Cost of equity after raising debt. So this can be gotten using Gordon model for sure. It can be gotten using Gordon model. But now the question is, if you look at this question, do we have that information that is going to help us to do Gordon model? We don't have any information that is relating to dividend. Yet we know we can do cost of equity using Gordon model, but we don't have any information that is talking about, we don't have any information that is talking about cost of, we don't have information talking about dividends. And that's how the examiner will separate the two methods depending on the information that they have given to you. So if you try to look at this information that they have given to us in the question, if you try to look at this information, they have told us the cost of an ungeared, this is ungeared, it is 15%. They are telling us if they propose to raise at this, but we want cost of equity after they have been geared. So if you look at the kind of information that we have here, the only method that we can use is what we call the M and M. Remember, I told you that when you are computing cost of equity can be computed using Gordon model, using Modugira and Miller, or CAPM. But so far, we have not looked at, we have done Gordon model, we haven't looked at CAPM. But right now, we are finalizing with Modugira and Miller, and we are trying to compute cost of capital using M and M. So the only method that is going to be applicable is the Modugira and Miller. So we are trying to look at the cost of equity when we are using M and M model. So one thing I want you to note is the fact that M and M has issues. You have to know whether the company is geared. If the company is geared, then you need to know what is the composition of debt to equity. So now they told us that cost of capital for a geared company, it's a geared company, KEG, cost of equity of a geared company. This is ungeared. If you base on the information that we had, is equaling to KE, cost of equity of a geared company, equals KEU, that is cost of equity of ungeared company, plus, put this in bracket, KEU minus KD into 1 minus T VD over VE. So we all know the information. Cost of equity of a geared company is what we are looking for. It is this one. It's the one that we are looking for. But we have cost of equity of an geared company. They told us it is 15% plus the cost, of course, this is cost of equity of ungeared company, that is 15%, minus what is the cost of debt? The cost of debt they told us is 8%. Of course, you don't adjust, because now if you adjust this one here, remember in this formula we have the tax component that we are going to adjust. So we just bring the other cost of debt as it is before, then we adjust here 1 minus the tax rate of 30%, because they told us the corporation is 30%. But they also went ahead to give us the composition, debt to equity. This VD is actually, VD is the value of debt over value of equity. They gave us the ratio, which is 0.4 times 0.4. So when you take that into your computation, you'll be getting 16.96. That is roughly 17%. That is the cost. So that's part A. That's how we compute that cost of equity. So when they give you debt to equity, the other thing that I need to explain, debt to equity, they gave us a 0.4. It means that now, of course, you know this is 0.4. If you multiply by 100, you make it a percentage, it will mean that the implication here is just simple. It would mean that you have one part is 40% and the other is 60%. Of course, once you add the two, they will give you 100%. So we have our debt as 40%, then equity is 60%. Because the entire thing is what? So the entire company, the composition is 100%. So you need now to get what is your work. Of course, we know the formula for work. We said work equals VE over VE plus VD times KE, that is cost of equity, plus VD over VD plus VE. Of course, this one you multiply by KD, but adjusted for tax, 1 minus the tax rate. That's the formula. But since the company is not geared, because before, remember, we are computing cost of this part B. You see, part B, they told us to compute cost of, they wanted us to compute work. But before, this is before gearing. Before gearing, meaning the company never had debt in its capital structure. So if the whole of our formula for work, this formula that you are seeing here, the whole of this, we are seeing that the company is not geared. So what is the implication? The whole of this is going to be zero because we don't have any D, we don't have cost of debt. The whole of this is going to be zero because the company is not geared. So work will only be this point. So we are going to just pick, so it is just going to be, we are going to compute work as just a matter of picking VE over VE plus VD times KE. We are not going to use the other answer that we got in part A, because part A, we got cost of equity for a geared company, but this company before it wasn't geared. So we are going to use the other cost of ungeared company, cost of equity for a ungeared company they gave us in the question of 15%. So I told you the debt to equity, they gave us the percentages. So now the implication is that the VE was 60% over the VE, which is 60. But now we don't have anything to do with what? We don't have debt, meaning this one is going to be zero. The value of debt, because value of debt is not there. So it is going to be times the 15%. Of course, this one is going to be 6 out of 6, that will be 1, and that will give you the exact answer as 15%. So before it doesn't change. But of course, if they give you that question, of course, the answer is already in the question, but you make sure you compute. To show, just pull out the formula, put in the figures. Because even if you just come here and you keep on adding their zeros in this formula, and you put here, there is a 0 here, there is a 0 here. Of course, there is no way you are going to get 0 out of something. The whole of this is 0. That's why we took it off. But this one is not a 0. So that's why we put in the formula just to show what we did. In other words, it's like the company is 100% equity. Now, the issue is about after gearing. This part C, or the other part of after, they want to work, but this time around after gearing. After gearing, we said work equals VE over VE plus VD, of course, times KE plus VD over VD plus VE times KD into 1 minus the tax rate. So we put in our values. Remember, we know the compositions. This one we know it is 0.6 or 60% VE. 0.6 over 0.6 plus 0.4. Now here we are taking the one for a geared company because it is now after gearing. So it is going to be 16 point, let's take the rounded figure, which is 17%, plus, of course, 0.4 over 0.6 plus 0.4, then times 8, but this 8% is supposed to be adjusted for tax, 1 minus 0.3. So this one is supposed to be 0.0 because it is 8%. So once you compute this, of course, this is going to be over 1. The whole of this, because this is 0.6 plus 0.4, that is 1. That is 1. 1.0, even this one is 1.0. So we're just going to take the other 0.6 times 17%. Then we also take 0.4 times the other. So it is going to be 0.6 times 17%. Of course, here we can remove the percentages so that we maintain decimals. 0.6 times 0.17 plus, because this is over 1, plus 0.4 times, this one is 0.8 times 0.7 is giving us 0.056. It is also over 1. So this one times 0.4. So this is giving us 0.0224 plus this is giving us 0.102. So once we add, we will be getting 0.1244. Once you convert it to 100%, it will be 20%, 12%. So this 12% is now going to be the cost of capital after gearing. So that's what I wanted you to get from the computations that we wanted to do. Now, what I'm going to look at, or what we are going to look at after this, in the next video, we are going to be looking at the dividend decision. The dividend decision. We shall look at more numbers, because I told you there is a topic where we are going to be more interested after doing portfolio. We will be more interested into looking at all that, because at least we will be done doing CAPAM. When we do CAPAM and we are done with CAPAM, then we can be able to compute the whole cost of capital, and we shall be using all these formulas as I've given you these formulas. So now let's look at the dividend decision. Dividend decision. Now, of course, as I told you earlier, that as a finance manager, or as a senior finance manager, or as a CFO of an organization, you are responsible for 4 decisions. And we said you are responsible for capital budgeting decision, that is investment decision, capital budgeting. You are also responsible for financing decision. You are also responsible for working capital management. And lastly, you are responsible for dividend decision. Dividend decision. And this is what basically I want us to look at today. So I want us to put in context the dividend decision, because we need to be fully prepared on this area, because it's one of the areas that we don't put much emphasis as far as level 2 financial management is concerned. So you are aware that at the end of the day, and at the end of it all, when we have when we have worked, we have made some money as a business, we need to pay dividends to our owners or our shareholders. So once you have made any profit, it's advisable that you pay dividends to your owners or the shareholders. As I said in the paper, in the financial management paper for level 2, dividend policy was not all that heavily pronounced, but here you can find a question that is taking like 25 marks, just one number on dividend decision, or the examiner can actually put some parts that are carrying maybe 13 or 12 marks in a given numbers. So therefore, we are saying that dividend decision determine the amount of and the way in which a company's profits are distributed to its owners. So, but this topic is the one that helps us to understand how much and how these companies' profits are distributed to the owners of the business. So the dividend decision may affect the views of the company's long-term prospects. And of course, the same will affect the market, the share market values or prices. For example, if you are that company that doesn't want to pay dividend to your shareholders, that you make profits, and instead of declaring that you are going to be paying dividends, you say we are going to plow back the money. Every time you are plowing back the money, you don't pay your shareholders. So it has an impact. It can first of all affect the long-term growth of the business, because the people who are buying shares will say for sure, we are not going to buy shares for such and such a company, because after all, it doesn't actually pay dividends. Two, even the market price, because if people are not buying your shares, it means you are not performing well. Because if you are performing well and you are paying them, then the share price has to keep on increasing. So if you are not paying dividends, then the share price will actually fall at some point, because it's the market that dictates the price for your company's shares, depending on how the performance of the company is. So it will affect the people who are going to come in to buy the shares, because if they hear that maybe you have spent like 5 years, you are not paying dividends, then 5 years, 10 years, you are not paying dividends, and they are not seeing any tangible growth in the business, it can distract or it can discourage people from buying shares in your company. So you should always know that payments of dividends is very important. But the other thing that you should also note is that when you pay dividends, it limits the amounts of retained earnings. Retained earnings, those are the accumulated profits. Retained earnings that are going to be available for reinvestment. So if you pay out dividends, then of course it is going to affect how much you are going to be left with as a company in terms of retained earnings that can be used to plow back. Of course, you know, the retained earnings, if you make profits, if let's say you are that company and you have made maybe 10 billion in profit after tax. So if you have made 10 billion, at least we expect maybe you can declare, let's say 25% or 30% into dividends. so that you can be able to remain with the 70 in the retained earnings. Once you remain with 70% in retained earnings, that is going to be like 7 billion. You give out the 3 billion in dividends, then you retain the 7 billion. The implication is that once you want to make an expansion of the business, if you want to make more investments, you are going to use this money. You will not go and borrow. You are going to use the 7 billion. So if maybe you have an investment of, let's say, 5 billion, you can use the 5 billion, then you remain with a retained earnings of 2 billion. Then this 2 billion will find the other amount that you will be making next year. If next year you make a loss, it will compensate. At least you will not be left out. Still, even the investment is going to be done because you have maintained some retained earnings. So the moment you pay out dividend, you are reducing on the amount that you are going to retain as a business. It's going to be a little bit limited. So that's what you should understand. Let's now look at a dividend policy. Dividend policy. Now, dividend policy is advanced by two theories. We have two theories that are advancing the dividend policy. We have these theories. There is what we call the dividend irrelevancy theory, and then there is what we call the dividend relevancy theory. Now, the dividends, this first one, the dividend irrelevant policy, this one is the one that was advanced by M&M model. M&M, Mondgirian and Miller. They are the ones who advanced this, or who developed that, the dividend irrelevancy model. So for M&M is also coming back within the dividend policy. Is coming back as the proposer of the dividend irrelevancy theory. Now, we want to understand a little bit about this first one, the dividend irrelevancy theory. Now, this we've said it was brought by M&M, Mondgirian and Miller. Mondgirian and Miller. They are the ones who brought that theory. Now, according to M&M model, or according to Mondgirian and Miller, I need you to get the difference. There is Mondgirian and Miller basing on the dividend policy. There is also Mondgirian and Miller when you are looking at capital structure. Those two, they are totally different. The other one is looking at capital structure plus the impact on cost of capital. This one is basically looking at the impact of dividend. It is all about dividend policy, whether we should be able to pay dividends or we shouldn't. Now, with this M&M or Mondgirian and Miller, for them, they are insisting that it's irrelevant. For them, actually, they are saying it is irrelevant for you to pay dividends. It's irrelevant. It's irrelevant to pay dividends. It's irrelevant to pay dividends. That's what they are saying. But for the dividend relevance theory. The dividend relevance theory is the one that was, actually this one is one that we call the traditional school of thoughts. So this one was advanced by Gordon's model. Was advanced by Gordon's model and the Walters model. And for them, they are insisting that it is relevant. It's relevant to pay dividends. That's what you can say in short. In short term, that's how you can explain if they tell you to explain about the dividend relevance theory and then the dividend irrelevance. Of course, this one I said the dividend relevance is the one that we call the traditional school of thoughts. Traditional school of thoughts. So you should also note that this one is different from when we are talking about the traditional school when we are dealing with capital structure. It is a little bit different. So it is the one that we call the traditional school of thought. That is a dividend relevance. It was advanced by Gordon's model, and then the Walters model. They are saying it is irrelevant for you to pay dividends, and they have their own reasons. Of course, the examiner will, most of the times, if it is not all about the computations, they are going to be asking, why is it relevant for you to pay dividends? Why is it irrelevant for you to not to pay dividends? Those are the questions that those are the kind of the questions that you are going to be finding. And if this question comes, because I told you that dividend policy could be a full number carrying 25 marks, but out of these 25 marks, the examiner can put some calculations maybe with 13 marks, then the other theoretical aspects with 12 marks. So 13 could be calculation, or it could be theory, then the other one is calculation. So the examiner has also a right to bring it in other numbers. I remember I told you, here you will not find one question coming from one topic. It will be hard. If you find it, then it means the examiner actually just wanted people to pass. But what they do, they always mix topics. So you find question 1 has like 8 topics have been mixed. And that's what makes students to fail or pass. Because there are those who are not going to understand the full topic. And if it happens and they say what they know, they have passed. So it is a win-win situation. But at least it is better for you to understand the topic fully, and you can do the computations that are within that topic, and at the same time you can be able to handle some small theoretical aspects. Because I know we accountants, we have problems with writing. The things of reading theoretical things, we have problems with it. But it's where the easy maxes are. Because you can find a question like this, they are telling you why is it important for you to pay dividends. And they have given it maybe 10 marks. For you are still struggling with computations, which you don't actually even know the formulas. You have even failed to interpret the question. So that's why I'm saying it is where we have the easy marks. That's why I haven't gone to investment decision, because I want to first have these easy marks. They are very easy to get. Like this number for dividend policy it is very easy for you to actually maximize it if you are very serious. So what we are going to look at in the next video, we are going to look at a detailed analysis of these methods and what they really talk about in detail. But at least you have gotten a hint that the dividend relevance theory is the same as the traditional school of thoughts. It was advanced by Gordon and Walter's model, but their argument is actually to pay dividends to shareholders. The other one, the dividend irrelevance theory, is the one that we call the Modiglian and Miller theory. It was advanced by Modiglian and Miller, and their argument is that it's irrelevant for you to pay dividends to shareholders. So they have their own reasons, and they are also right. So there is no right or wrong kind of argument, but get to know what we are talking about. So in the next video, we are going to be talking about dividend theories. And specifically, I want us to start with the Modiglian and Miller. The Modiglian and Miller approach. You can call it a model or approach, what we abbreviate as M and M. Now, this Modiglian and Miller, they argued, remember from the other aspect of capital structure, they argued under the capital structure that capital structure does not matter in the valuation of the company. And they are also coming back to tell us that indeed dividend policy doesn't matter, or paying dividend doesn't matter. So they are coming back to tell us the same thing. So that is our number one. Number two, we had the traditional, sometimes they call it residual theory. This is the traditional school of thought. So this is, as I said, it is also called, it can also be called the traditional school of thought, traditional school of thoughts, or the residual theory, but mostly known as the traditional theory or the traditional school of thoughts. And I don't want you to confuse the two, as I told you, the two approaches, because we talked about the same theories under capital structure, and now we are using the same theories under dividend policy. So I don't want you to get confused. So they tend to resemble, but one side is on capital structure and the other side is on dividend policy. So for examination purposes, the examiner can ask you to explain the theories, can also ask you to give the assumptions, to give the limitations of the assumptions, or to give the relevances of the assumptions. Sorry, to give the relevances of each of those theories. But remember what we talked about. If they ask you about the assumptions, you give them the way they are given to you. If they are talking about limitations, then you just criticize those assumptions. So without wasting time, let's now look at this first one, the Modiglian and Miller approach, because I wanted to shed something so that by the time we dive into one, you actually know what we are talking about. So we are looking at the Modiglian and Miller, M and M. I'm going to be using M and M, but just know it means Modiglian and Miller. We can also call it school of thoughts. Modiglian, M and M school of thoughts. Because this is their ideas. That's why we call them thoughts. School of thought. Of course, this is the classical position. Now, these guys, they came up with their argument in 1961 on dividend. This is on dividend policy. I don't want you to confuse yourself with what? With the capital structure. But the same way when they developed is the same way when they developed even the capital structure. But it was just before, because the capital structure was the first. The capital structure, for the record, the capital structure was advanced. Capital structure was advanced in 1958. And it was improved. Of course, the revised edition. The revised edition was 1963. But the examiner will not be asking you these years. In other words, what the examiner wants, he wants for you to understand the arguments. There are different arguments they talked about, and these are just, they are more of things you should know. If you don't know, you don't know. So there are things that they talked about. And I want to be very clear with them. Number one, these guys are, for them, they are saying that for sure you don't pay dividends. That's what they are saying. These are the arguments. I'm just going to highlight some of them. Don't pay dividends. Don't pay dividends. That's what they are saying. In other words, for them, they are saying that it's irrelevant to pay dividends because the value of the company is not determined by how much you pay in dividends. You can't determine the value of the company by just looking at how much you have paid in dividends. That's not how we determine the value of the company. We know that we determine the value of the company by discounting its future cash flows. That's how we determine the value of the company. So for them, they are saying don't pay because, after all, it's not, the value of the company is not determined based on how much you have paid in dividends. And that's the argument. So according to M&M, dividend is irrelevant to them. And that's why we call it irrelevant or irrelevance theory. And that's why we don't pay dividends. If we don't pay dividend, then it's automatically, you as a company, you are following the M&M. So we don't pay dividends. Of course, under the perfect market situations, or perfect market situations, they don't exist. But under the perfect market situations, the dividend policy of a firm is irrelevant. It is irrelevant because it doesn't affect the value of the firm. So it doesn't matter whether a firm pays dividends or not. So here, the shareholder is going to be indifferent. So M&M says don't pay dividends, and that's all. And that's basically what the examiner is going to be asking you. But of course, the assumptions, every theory has assumptions. Number two, M&M are also arguing that the value of the firm, they are also saying that the value of the firm or the value of the company entirely depends on its earnings. So it depends on its earnings the same way we saw it under capital structure, because they are saying that the capital structure does not matter in the value of the company, since it only depends on the company's earnings. Similarly here, they are arguing that the dividend policy or payment of dividends does not determine the value of the company. And what matters here, the value of the company is entirely depending on its earnings. Therefore, payment of dividend is irrelevant. So if you see companies not paying dividends, they could be following M&M model. So there are two arguments. They are saying that the value of the firm entirely depends on its earnings. Number three, because these are just key points that you should note, because the underlying argument is that they will ask you, why are we not going to be paying dividends as per M&M? Or according to M&M, it says paying dividends are irrelevant to the success of the business. Discuss. So you'll find yourself giving these points, that the value of the firm entirely depends on its earnings. The other key concern is you need to pick it according to what they are thinking is, because they are saying that the sources of equity finance is in itself irrelevant. Like, because we know that, remember their argument, for them they are saying it's borrow and borrow and borrow and borrow in the capital structure. So it's like they are looking at dividend at equity finance as if it is not important. So since they are saying you keep on borrowing up to 99.9%, it means that they don't value the equity contribution at all. Because in their argument, it's like, even if it's not there, the company can actually survive on debt. That's their argument. So the key point that we need to note here is that the sources of equity finance, they are also irrelevant. So because if you don't have equity shares, are you going to be paying dividends? Of course not. So that's the implication. We are getting it from the other aspect of capital markets, because they are saying you use more debt than equity. You be borrow as long as you can as a business. So for them, they look at the money that has been contributed, because we said you can't have 100% debt. So they look at what the owner contributed to the business as a sacrifice. They look at it as a sacrifice in earnings. Because you contributed some money and now you want a dividend, the money they are going to be paying to you, it's like they are losing it, because it's like a sacrifice for the capital that you contributed. So for them, they argued in the capital structures we talked about that you can borrow up to 99.9%, meaning that having equity finance is not all that important according to them. Even if you don't have it, you can still boost the business. Number 4, the other argument that we can talk about, we are just bringing out key points, and these key points, they are the standing points for you to get the marks. Now, this point is always the biggest. It is always the biggest issue, that capital gains. It's very important. Capital gains compensates for the advantages of current dividends, and also delusion of control or ownership. Delusion of ownership. You know, when you have equity, or when you get more equity, you are likely to be giving out your share of control. In other words, you are inviting more people to come into your business to make decisions on how you should run the entity. That is delusion of control, but which is not the case with the debt. If you get the debt, for them, they only care about them getting their money back. Whether you invest the money in illegal activities, as long as you pay them back, they don't care. So if you issue these shares, then we are going to have the biggest issue, that we're going to have things to do with delusion of control. So for them, they are saying that the biggest issue is that capital gains, the capital gains you are getting, they are the ones that are going to be able to compensate for the current dividends. So if you don't pay dividends, like, in other words, if you don't pay dividends, eventually you will gain more from taxation issues. Of course, you know from your taxation what they call capital gains. You know, capital gains in taxation, it's a very fantastic topic that helps someone to earn something, because these dividends, once they are accumulated and you continue investing it back, eventually the capital gains you get as a result of you doing that kind of continuous investment of that accumulated profit that you've been keeping aside without paying dividends, you can earn the capital gains that will be the ones to compensate for what you would have taken as current dividends. Because if you leave the money to accumulate there and the money is reinvested somewhere, it means you are going to be earning more money. It's going to be coming in as a result of the investments that you've made. But their argument is that those gains that you are going to be getting will compensate the current dividend that you would have received. So, and probably that could lead into delusion of ownership, because if you keep on paying dividends in one way or the other, then it could be an issue, because when you give out dividends, you have lost money you would have invested. So if you want more money, you are going to go in for borrowing. Finally, we can look at maybe something small. M and M, they are also saying dividend is irrelevant. They also say that investors can affect their return on stock regularly. Like, they can affect their returns. Investors can affect their returns on a stock or share, whichever it is, regardless of regardless of the stockholders dividend or of the shares dividend, regardless of the stockholders dividend. So what do we mean by this? Now, what we mean, in other words, when we talk about stock, these are shares, and you can affect the return on your shares regardless of whether there is dividend or not. So M&M is following up on the payment of dividend as irrelevant and nothing else. In other words, if you look at the stock, there is an impact because you can choose to sell and get back your money and you earn something. Because now, if the share has been, maybe you bought the share, maybe let's assume for MTN, they were for 200 or 250, whichever. But now, do you think someone can't sell their shares for MTN? So the question is, how much are they selling now? You can go and sell and you make more profits because it is going to keep on changing hands. I had my shares, they were small, they were not paying, or they were paying me small. I sold them out. So those are some of the things that we look at. Now, I want us to focus on the assumptions. Let's look at the assumptions of M&M. Assumptions of M&M theory. You can call it theory, you can call it approach, you can call it a model, as long as you know what we are talking about. But these ones, we are just going to list them. They are saying that there is a perfect market. In other words, investors are rational and they have access to all the information for free of cost. So they are saying, when the market is perfect, it means everything is available. Free information, you have it on all the available stocks, their markets, which is not true at all. But as you are giving, you just state it the way they state it. But me, I'm trying to explain so that you know, because I'm not going to give the limitations, you know what to put in your limitations. They are saying there is no flotation cost. Flotation costs, those are extra costs that you are going to incur when you are going to float your shares on the stock exchange. There are very many costs that you are going to be incurring. Advertisement, you are going to get stock brokers and others, underwriters, lawyers. There are very many people that you are going to be paying for you to be able to float shares. But they are saying all that is not there, which is unrealistic. They are also telling us that we don't have anything to do with the transaction costs, that investors are rational. They are also telling us there are no larger investors that can be able to influence the marketplace, which is not the case, because there are those that can actually dictate. So they are also saying that the securities are divisible, that you can divide. So the other, number two, they are saying that there are no taxes. There are no taxes. Both dividends and capital gains are taxed at the same rate. Of course, you know capital gains are taxed, and also dividends are going to be taxed. If you earn it, the government comes, because you also declare on your own whatever. That is where you are going to declare the money you have earned. Number three, the model assumes that companies follow a constant investment policy. They assume that companies follow a constant investment policy. In other words, the implication of this is that there is no change in business risk position and the rate of return on the investment in the new projects. That we are not going to have any change in the rate of investment, which is not true, because they are going to assume that we are going to be earning constantly. The other, they are saying that there are no uncertainties about the future profits. No uncertainties about the future profits. Certainties about the future profits. In other words, all investors are certain about the future investment, and dividends and profits of the firm are going to be there with no risk involved. So some of these are not true. So those are some of the assumptions that we can give. But as I said, you give them the way they are given. So let's look at the M&M approach formula. M&M formula. We have a formula that we use, or that they advanced, that is going to be used to be able to compute the dividend. Now M&M provides a formula for computing the market. This one is going to help us. They are saying is going to help us to compute the market value of the share. Market value of a share. But it's not common in exam, even though the new examiner may attempt to bring it, but it's not something that is very common. So they are saying the formula is P, which is the price. It is D1 plus P1. There is a 1 there. Then 1 plus KE. Where of course the P naught, or the P, is the market price per share at time 0, time t, time 0, per share at time 0. That's why I'm putting P naught. So we can also change the formula. We put a P naught here, because this one is P1. P naught. Then our D1, of course, this is the dividend per share at time 1, or period 1. Then P1 is of course the market price per share at time 1, or period 1. Then KE is actually the cost of equity. Cost of equity. So that's the formula that we use to be able to compute that. But we shall also look at other ways how we do the computations. But that's a formula that was given by the person who developed the model M&M. So that's all that I wanted us to look at as far as Modiglian and Miller is concerned. The next one that I want us to do is I want us to look at what we call the traditional theory or school of thoughts. The traditional theory of dividends. That's what dividend policy. And that's what we are going to look at in the next video. So let's move over to the next video and we'll look at the traditional theory. Well, once we are done with the traditional theory, we shall look at some small formats of how we can be able, the different methods that we can use to be able to compute dividends. And once we are done, that will be the end of that dividend policy. It's not something that is very wide. Right now we want to look at the traditional theory of dividend policy. So we said that this was advanced by Gordon's model and then the Walters model. And for them, they are holding the traditional view that payment of dividend is very important. Payment of dividend is very important, and that's the traditional view. So for them, they are holding the traditional view that payment of dividend is very important, and that's what we call the traditional school of thoughts. So it's the one that we call the traditional school of thoughts. The traditional school of thoughts. So, of course, the traditional school of thoughts where payment of dividend or payments of dividend is extremely very important. Now, their argument, they argue and they say that shareholders prefer to receive a shilling today than to wait for the future, because the future is full of uncertainties. So for them, they look at two issues. They look at issues to do with the time value of money. In other words, for them, they prefer to receive a dollar today than waiting and you maybe to receive a dollar in 2 years' time. We also saw that when we are discounting cash flows, it's always, if someone tells you in 5 years' time, I'm going to give you $1,000. Let's say in 2 years' time, they are going to give you $1,000. Now, the question is, what will be $1,000 today? So the $1,000 that you are going to receive in 2 years' time is the future value that you expect to receive. But the question is, how much is that money now? So for you to be able to get that, we discount the cash flows and we get its present worth. So for them, they are saying, because now waiting for you to receive an $1,000 in 2 years' time, it is very okay for you to receive it here and maybe you receive like $800, because once you receive it now, you can invest it, you can even consume it, you can do other things, because money that they have promised you $1,000 in 2 years, you can't eat it today. It doesn't support current consumption. So there are so many reasons as to why they actually look at the time, they consider the time value of money, that the money that you're waiting for in the future, by the time it reaches, the inflation will be high, because now, given the fact that we are developing countries, the inflation is already high. By the time you wait, it is already losing value. So that's why for them, they argue that shareholders prefer to receive a dollar today than to wait and they receive a dollar tomorrow, because they are not sure of the future. The future is uncertain. So it is uncertain and it has very many risks like inflation and other kind of problems. So they further argue that these assumptions that were made by M&M, they are unrealistic. That's what they are saying. They are saying that M&M assumptions are unrealistic. Being unrealistic means they are not applicable. Of course, they told us there is no taxes. Of course, there is no way you are going to operate business and you don't have taxes. They are telling us the perfect competition. Of course, it's not there, except in developed countries. So it's not applicable. That's what they are saying. So they argue that the assumptions that were raised by M&M are not applicable, because in the real world, investors might prefer one dividend policy over another. And we are going to look at the different types of dividend policies that we have. Now, the dividend policy is still a big argument, and economists are still arguing about it. And it has been resolved because there are those that are going to be, of course, it has never been resolved because there are those that are going to be in favor of the other M&M that says don't pay dividends, but others are still following the traditional approach that requires paying dividends. So the examiner can ask you about the determinants of dividend policy, and we are going to look at them later. The determinants, they are like factors. What forces you to pay dividends, or what forces you not to pay, or what makes you not to pay dividends, or what makes you pay dividends. So that those are some of the kind of things. But as I told you, the argument is still ongoing, given the fact that in reality, people are taking it their own way. There are those companies that pay dividends going by the traditional way. There are those that don't pay dividend. And that's why I was telling you that it's not all about to say that this is right, this is the right theory, this is not. You just go by understanding what it talks about, then you can be able to reason it out if at all it comes in the paper. So I want us to look at the relevance. These relevances, they are like the significance or the arguments for. In other words, the advantages of you paying dividends. So arguments for paying dividends, as advanced by the traditional school of thoughts. As advanced by the traditional school of thoughts. Number one, of course, these are things like the way they were given by the people who developed the model. You don't just use your own answers and you just you think you'll get all the marks. It's better you start with those that were advanced. At least you give like 3 to 2 if at all you remember them. 3 or 4, then you add your own. But it's better to start with those that were talked about. One, they said the one bird in hand and 2 birds. The one bird in hand and 2 birds in the bush. The one bird in hand and 2 birds in the bush argument. These arguments that were made by these people. So we give them like the way they are. Now, what do we understand by this argument? Of course, from the English perspective, you can understand that it is better for you to hold what you have, the one you have, than chasing the one that are still in the bush. But let's understand what these guys were trying to analytically talk about as far as dividend policy is concerned. Now, in other words, just like the way I've said it, it is better, you will be better to have your body today than hoping that you will get 2 birds that are in the bush. That is the mere implication, the mere understanding that it is better for you to have your body today than to wait that you will get the other 2 in the bush. So I don't know whether these people they were actually hunters, but these are just proverbs. But these are certain things you can actually You can actually put in context. So it is the assumption of having a 1 shilling today as opposed to getting 2 shillings tomorrow. Because tomorrow, we all know that tomorrow never comes. It comes and it has its own story. Then you say tomorrow, tomorrow, tomorrow. Tomorrow never ends. So what happens is the fact that their argument was basically looking at the time value of money. That it is better for you to have the money today, to have $1 today, than waiting that I will have $2 tomorrow. So it is better you have the dollar, because if you have the dollar today, you can actually eat it, you can invest it to earn more money. You can also save it and you earn some interest on it. So money you have received today is better than the money that you will get in the future. That's one. The other point, these are points as they were talked about. Payments of dividends, payments of dividends signal good news. Payment, of course, once you pay dividends, it provides a signal to the audience or to the public, some good news about the organization, without even telling them. As long as you have paid dividends, the people, even if they have not actually received, they are not the real shareholders, but it gives a good signal that actually this company is performing well. That is what we are calling payment of dividends signals good news. So here people are thinking that you are performing better when you actually pay dividends. And if you don't pay dividends, then people may think, of course, first of all, the shareholders are not going to be happy themselves. Even the public would actually think that these guys they are not actually making money. So the market, once you pay dividends, it is going to give a signal to the audience that you are actually performing well, and even the market value of the share will actually increase. So if you don't pay dividends, it will, of course, no one will want to actually buy shares, however cheap they may be, because they know at the end of the day you are going to take long to pay them, yet you are just using their money. So that alone can actually affect the price of the shares. The other that I need to talk about is the fact that investors they invest precisely to earn dividends. Investors invest precisely to earn dividends, because they put in their money thinking they are going to get more money. So investors, they part ways with their money in order to earn dividends for the money that they have invested in the business, and that's their primary goal. So they put in their money thinking that at the end of the year, based on what they have, how they have performed, they are going to earn something. And most of the people who are going to put in their money, they have capacity of putting that money somewhere else, but they don't actually have time to manage where they are going to invest that money. So what they do, they put that money in the business, they expect you to work and make them earn something. That is the primary objective. Even though others may have a motive of having this organization to be there for long-term survival, gaining the market, and other kind of stuff. But their primary objective is actually to earn dividends. The other is that the fact that their existence of transaction costs. Existence of transaction costs. Now, how is it a way for the shareholders to demand for dividends? It happens when you're issuing shares or when you're buying shares. Like if you're not buying it for the first time during the initial public offer, IPO, if you're buying shares right now, like MTN sold their shares a long ago, in that first primary market through the IPO. So once that is closed, you can actually still buy MTN shares from the stock market. You are not going to just go and buy shares yourself. You have to go through stock brokers. These people are not going, they are going to charge you commission. They can help you sell and also help you buy shares. So they are going to charge you commission. So you are seeing that before you even earn, you have already paid the broker, the stock broker money. You have paid before these guys start giving you dividends. So the reason that there is an existence of costs for me to acquire those shares, it makes me demand for the dividends. Even though it's all about management to actually make decision, but at some point when they sit in their annual general meeting, which is the AGM, they discuss some of these issues. They can actually pass a resolution to make you pay based on how much you have made in the profit. So, because that's the only way shareholders are going to be communicating to the business or the management of the business, because they communicate through the annual general meeting. So the existence of these transaction costs cause people to demand for dividends. So the traditionalists are saying that there are these costs, including, of course, some of these costs, they include flotation costs, brokerage costs, underwriter costs, and other people, lawyers that are going to help you interpret some of the items that you may not actually understand. So in fact, if you don't pay the dividends today, then the dividends will be chewed by the flotation costs, because they incurred these costs today. And for you, you have passed maybe 1 year, you have not paid dividends. 2 years, you have not paid. 3 years, you have not paid. By the time you pay, if I told I incurred the flotation cost of 2 million and you are paying me, let's say, dividend of 3 million, are you not seeing that it has already lost value? Because as I incur the flotation cost, I'll keep on accumulating it. In other words, I'll keep on compounding those costs. That if it was paid, maybe if it is going to be paid, if I have made a present payment of, let's say, 2 million in flotation costs, how much will it be in 2 years? So you'll find if I told them to compound that figure, by the time you pay me your dividend in 5 years' time, this compounding I've done with the flotation cost would have chewed off the dividend that you have paid, however big the dividend would be. So that's one of the reasons as why they demand to be paid. The other is the need for diversification. Need for diversification. Diversification is all about having very many entities. If you are that person who buys shares, for you to manage risks that are associated with the money that you are investing, is to make sure that you invest in so many companies, so that if this company doesn't earn profit, or if this company doesn't pay me dividends, the other company will actually pay me. So, but what am I going to do? How am I going to be able to invest in this money if at all these guys are not paying dividends? So once you pay me dividend, I will use that dividend to go and invest in other stock markets. Once the other one pay their dividends, I buy more shares in the other company. So that's how diversification comes in. But I'm not using my own other money, but I'm just the money that I invested in. It is the one that brings back the return, and it's the return that I'm reinvesting in other companies. I'm reinvesting in other companies because I want to spread the risk. If you don't pay dividend today, at least I will get dividend from the other company and I buy in another company. So that's the kind of movement that I'm talking about. So investors need to be paid their dividends so that they can invest that same amount that they have received in other businesses as part of managing risks through what we call portfolio. We are going to learn soon after this, we are going to be learning portfolio analysis. We shall be seeing the risk of you investing all your money in one project than investing in very many different projects. The other is the tax argument. Tax has issues. Of course, these dividends are going to be taxed. Let's assume you are going to be taxed, or because it's going to come as money that is coming in from, maybe you had bought some shares somewhere and money is coming in. Let's say you bought in let's say a different stock market, not basically Ugandan stock market, and you're supposed to declare all your money, all your sources of income. So you find yourself you're receiving some money and they are going to charge you. So the tax arguments, they are really tricky because they keep on changing every year. Today, you may say they are not going to tax me on dividends. The next day they wake up and they say, we want to tax you. Are you not seeing that you are going to be losing money through taxation? So that's why you may want to actually be paid dividends. So those are the things that I think they are important as far as the traditional theory is concerned. And what I want to look at now, I want to basically look at the forms of dividend payment. We have looked, they have, let's say, agreed we are going to pay you, but the question is, how many forms of dividend payments are there? And how are they different from each other? So that's what we are going to look at, to be looking at the forms of dividend payments. Then after looking at the forms of dividend payments, then we can look at the determinants of dividend policy. After looking at the determinants of dividend policy, we shall look at the dividend payment policies. And then we conclude with the dividend capacity. And once we are done with the dividend capacity, of course, from the dividend capacity is where we are going to have a formula, where we are going to have a format of how we can be able to compute some of those different aspects. And once we are done with the dividend capacity, we shall go straight to another topic of portfolio analysis. So that's how we are going to be moving chronologically. Forms of dividend payments. Forms of dividend payments. Of course, this question was examined. It was examined, I think, December 2021, question 3. Yeah, question 3. So kindly note that some of these things, they are examinable, because we've seen that it was examined, and others, of course, if you cross-check, you will be able to see. But if you don't cross-check, you won't be able even to know where these things have ever been examined. Now, of course, we know the different forms. We want to look at, if they are paying dividend, how many forms, or how can dividend be paid to the shareholders if at all they have declared the dividend. Number one, we have what we call a cash form. Of course, a cash form, you could decide to settle your dividends in form of cash once you have made profits. Remember, it's always the decision of the management that decides to pay dividends, and they are the ones to decide how much they are going to pay. But once they have declared that they are going to pay dividend, then we want to look at what are some of the payment modes they can use to make payments. So you can pay cash, that's self-explanatory. Number two, we have what we call bonus shares. or what we call strip dividend. So the second way you could give what we call script dividends, and these script dividends, they are just paper money. It's not actually, they are just paper dividends. It's paper where people have received the dividend, but in form of a paper. And what we call a bonus share. What we call a bonus share, this is where you just increase. If let's say Charles had let's say 200 shares. So instead of me paying you money, I'm just going to increase the equivalent that we had declared we are going to pay, let's say 3 billion in dividends, but we are just going to increase each person's shares maybe by 100. So they add me extra 100 shares. So in the total, I will be having 300 shares. So that next time when they are paying, I will be receiving money on the 300 shares, not on the 200 that I had previously. Because this time around, I paid what we call bonus share. That was a bonus share. So you just increase their shares, their shareholding. So as a company, of course, as a company, it is very important. You look at the company, you can make, let's say, 5 billion. That's the 5 billion that you have made. And you as a CFO, you have 5 billion to pay out in dividends. But at the same time, because this is actually the reason as why you find these people not paying dividends and they decide to give bonus shares. So you have made profit before tax. This is profit after tax. But you find that you have made 5 billion, but in the same year, you find that, as of course, as the CFO, you can advise the business. So if you have 5 billion that you can pay in dividends, but at the same time, you have an investment to make as a business, maybe it is worth a 4 billion. Then the decision can be made that rather than paying them cash dividend, the whole of this amount, the whole of that cash, 5 billion, we pay it out in dividend, they can decide, of course, the CFO will advise based on what they are looking at in terms of sourcing for other new sources and other kind of stuff. So they can decide that instead of giving them cash of the whole of this 5 billion, they would go and, of course, you as the CFO, you need to undertake an investment of, let's say, 4 billion. So you need to look at the 4 billion here, that instead of you going to the bank to borrow, of course, when you go to the bank to borrow this same amount, you go for the bank loan, they may charge you maybe, let's say, 15% per annum. Now, what is going to happen is that you are going to be paying interest of 15% every year. But yet you had made 5 billion in profit after tax. So you can decide that instead of me going to borrow, let me not give these people dividends. And I use this 5 billion, of course it will be the 5 billion minus the 4 billion. I will be remaining with only 1 billion. So I can say I'm not going to borrow because it is very expensive for me to borrow. I will use my retained earnings or the profits that I've made, but I'm going to I've made 5 billion, but I need 4 billion for an investment. So what I'm going to do, I'm going to pick the 4 billion, then I can issue out this 1 billion in profit. Sorry, in dividends. The remaining of 1 billion. I can say, let me give these guys cash dividend. I distribute all the 1 billion. Then at the same time, because if they were supposed to receive 5 billion, then this 4 billion should be allocated to them in what we call bonus shares, so that they have received some little cash, but at the same time, you have gone ahead to increase their shareholding. If I had 1,000 shares, maybe you have added me 500. Now, next payment, I'm going to be paid on the 1,500 shares, given the fact that even on this 1 billion, at least I've received, even if it is just 200,000, depending on the number of shareholders and the shareholding of the person. So that's the kind of analysis that we are trying to look at. So you just increase their shareholding than you going to borrow more money and you bring problems. Because no shareholder is going to refuse by you adding them shares, because they know next time they will be paid on a higher share value or share amount. So you can decide to give them bonus share so that the cash doesn't actually move out. Because if it moves out and you have an investment to undertake, you will go and borrow. You have to go and look for more money. So as the CFO, you can advise based on the profit that is available. So because now if you pay them, you are not making them to be a little bit scared for the money that they invested and they are not receiving money, but at least you have been able to have something. Number 3, we can have what we call stock split. Stock split, this is all about split of shares. So you split the shares so that the company lowers the par value of the shares to increase the number of share proportions. Like what you can do, I can say that I had 1,000 shares and each share maybe was at, let's say, 200 shillings. What is going to happen after split? I can split my shares. The intention is to increase the number of shares. So if one share is 200, so under a stock split, they can make a decision where they can revise the share price from the 200, then they say maybe the share has been revised. The revised price maybe is around 150 shillings per share. Now, once you reduce this to 150, remember this person bought these shares at 200. So the whole share value was actually 200,000. That is the whole value for these 1,000 shares. If you do a share split and you reduce the price of the share, you revise, the implication will be you have to increase the number of shares for this person, because it's going to be like when I gave you 200,000, that is my worth. So after a share split, it will happen that this 1,000 times the 1.5, the new share price, is giving me 150. So what are we going to do? The next thing you are going to do, it's 150. How much am I left with to make 200? Is 50. The question is, how many shares are within the 50? That's what you are going to do. You get this 50 divided by the par value of the share. So you get 50,000 divided by the par value of 150. It means I'm going to be adding this person 333, of course 0.333, but a share can't be in a point. So there are 300 and let's say, because I'm not supposed to go below this, I can take 4. In other words, the shareholding of this person is going to increase from 100, from this 100, then it will be from this 1,000, it will be 1,000 plus the 334. So the whole share this person is going to be having will be 1,334 shares. What did I do? Did I change anything? I did not change anything, because I still computed the value, the worth of the shares. I just made a reduction in the price of each share, but the reduction was intended to make sure that I increase the shareholding, because it can happen when you're registering a company. The register of companies tells you the maximum shares, the nominal share, the nominal share capital of that company. They tell you. So once the shares are not there, you just split them. You split the price. Once you split the price, this person is going to actually have higher values, but the nominal is going to remain the same. Because here, if you add this 150 plus the 50, it will actually give you 200. So that's what we call a split share. If let's say each share was, let's say, 500, and you after a split you say we are taking it to 250, but someone had maybe 1 million shares. What are you going to do to this person once you have reduced this? Because it was 1 million shares times the 500, the worth was 500 million. It was 500 million. So it was 500 million. This 500 million was the worth of this person. That is the nominal value. So what I'm going to do after reducing this, I've reduced it by what? I've reduced it, I just divided this by 2. So this one I'm just going to multiply by 2. So meaning this person is going to be having 2 million shares. So that's when I get the 200 times the 200, which is the share price, I will be able to get the same amount, 500 million, but the shareholding has increased. It will be a benefit to the shareholder, because he's going to be receiving in the next payment, he's going to be receiving on the 200 shares that he has, not on the 1 million share that was previously there. That's another kind of payment. So what you have just done is just to make sure that you increase the shareholding, and as a result, this person next period will be earning more. If it remains the same, then you do the same. You keep doing that until you reach at a point where you can be able to pay. The other, number 4, which is the last one, we have what we call share repurchase. Just the word repurchase. Someone had bought shares. So once you make more profit, you tell them, why shouldn't we buy you out? We buy your shares in the company. So instead of us having very many people as shareholders, once we make our internal profit, we can decide to pay you off if at all you are going. If you accept the money, then you will be. So here the company can just repurchase some of the shares to reduce the number of shares. It happens, like for instance, we had reduced this number of shares. Maybe we had not made some good enough profit. So today we have made very good profit. We can do more of a split. If you don't do a split, then we can buy them off at the prevailing price. Whoever is willing, we pay them off and we remain with our shares. So once the company has made some money, it can be able to do such. So the other that I want us to look at is we wanted to also look at the determinants of dividend policy. What are the factors that are going to affect someone to choose a given dividend policy? Number one, we can have the legal restrictions. Of course, in Uganda, based on the Companies Act, it allows payment of dividends. But if you look at the Cooperative Act of 1991, this one doesn't allow payments of dividends until after 5 years. And that's why we are bringing the legal restriction, where there could be some provisions that are stopping you from paying dividends or allowing you to proceed with the payment of dividends. 2, we can talk about the trend and the magnitude of the earnings, trend and magnitude, or the size of earnings. So it could be that the earnings are very minimal, they are very small, we couldn't pay. It could be the fact that earnings are more, then you can be in a position to pay dividends. If you have made little money and you are still investing, then you may fail to pay dividends because of the fact that the size of your earnings are very minimal. The other that we can look at, number 3, is the nature of the industry. Nature of the industry. There are very many points. Nature of the industry. Depending on how the nature of your industry is, there are those companies that need to see themselves developing, especially when there is too much competition. Because there are companies that they can't strategically compete. So what they do, they may just say, we are not going to give dividends for 5 years because we are still building ourselves to be able to compete in the market at the given the prevailing competitive environment that is available in the industry. So you may decide to make more investment into things that are going to bring in more money than paying dividends. So it could be the nature of the industry. If the industry is so competitive that you need to equip yourself with very many items that are going to help you increase or gain the market share. Just like the way you see MTN and Airtel, this one, when this person advertises maybe a reduction in their bundles, even the other one has to copy. Otherwise, if you don't do, you lose the market. So if the market is a little bit volatile, you need to be able to have some good money that you can use to do such kind of competition. If the competition is too much in the industry, they may end up not paying the dividends due to the huge demands for money. So once you demand, there is a very huge demand for the money, because once you pay the money, you may be kicked out of business because you are going to lose cash and you are going to find yourself borrowing, which wouldn't be good. Number 4, we can look at the taxation policy. Of course, a higher rate of taxes leads to, of course, a less disposable profit. Once you find that the company has been overtaxed, you find that their disposable income is going to be a little bit smaller. So once it is small, then it means the profit after tax is also going to be less. And automatically, once the profit after tax is less, they will not pay the shareholders their dividends. So that could be one of the reasons as why they are not paying the dividends to the shareholders, because of more money was taken through paying the taxes, and you are supposed to pay them because it's mandatory. It's not like the one for debt where you first expense the interest before making the taxes, because you know interest on that you are going to be paying on debt is tax deductible, which is not the case for dividends. So once the tax regime is a little bit high, then you are going to find yourself with less disposable amount, and at the end of the day you will also have a lesser retained earnings that you can be able to distribute to your shareholders. You are going to save less in terms of retained earnings, at the same time you are going to also pay less in terms of dividends. So those are some of the things that we could talk about. There are very many factors that you can base on. Sometimes it could be the management itself, when they don't actually want to pay, even when money is there. So it could be within the management style, based on the management. Some people, they could prefer to make more investment than actually paying out dividends. So there are very many reasons as to why a company may have things to do with not paying taxes. So what we are going to look at in the next video is going to be basically on the dividend payment policies. We want to look at, what we looked at is how are they going to be paying the dividends. They are different from the dividend payment policies. These are going to be policies, but the other one, we are just looking at, if at all they have declared dividend, how are they going to pay you? They can pay you cash, scrip dividend, or what we call bonus shares. We have also things to do with share repurchase, shares stock split, and others. But here we are basically going to look at the policies. Every company has its own policy that we are going to pay a constant rate. This is the rate that we pay. It's constant. It's flotating depending on given scenario. So every company has its own policy. So we are going to look at the dividend payment policy. These are not ways how dividends are paid. No. The other one, they are just methods of how you pay the dividend that has been declared, the one we've just looked at. But what we are going to look at in the next video is going to be basically the policies that are going to be adopted. What are some of the different policies that can be adopted by an organization before you declare dividends? You have considered which approach or which policy, and that's what we are going to look at. The dividend payment policy, and those are the ones that we are going to talk about. There are only 5 policies. Dividend payment policy, payment policies. So of course this is an area that if you want to pass this topic, you need to understand, you must understand it, because it is where the examiner tries to trick it a little bit, because it has some computations, and of course if you want to pass the computations, you must understand this area. because these are the policies that you are going to be following whenever we are doing any kind of computation that you want to look at. Number one, we have what we call constant dividend. Constant dividends. Now, what do we mean by constant dividends? You can have a constant dividend payment policy as a company. You can say for us, in other words, for us, let's say every year we pay $50. And that's what you pay. You can say for us, every year we pay $50. And that's it. Or you pay 50,000 per share. $50 per share. Or you can be paying $20 per share. This amount is per share. So whether you have performed poorly, whether you have performed well, you still pay the same amount. And this amount, it is paid every year, year to year. You'll be known that that company pays only $50, or it pays 50,000, or 5,000, or 1,000, or 200 per share every year. Whether they have made profits, more profits, whether they have made less profits, they pay that same amount. So that could be one policy. The other, number two, you could have a constant growth. Constant growth. You need to understand how we differentiate the two. Now, constant growth looks at, it could be a constant growth, and people like, maybe, let's say this year, we can maybe put it in a table, a tabular format. That's when you will be able to understand it. I can say that in this year, year one, I'm paying $50. Year one, we are paying $50 per share. And then the next years, we are going to be increasing it maybe by 10%. But this 10% is going to be constant throughout. That every year we increase it by 50%. Meaning it is the rate that is constant, not the dividend itself. So if this year one, I've gotten 50. Year two, I will get, it will be, of course, I have to increase this 50 by 10%. So it will be 1.1 times the $50. And this will give me $55. Together. Meaning next year I will be paying $55 per. So it is only the percentage. The third year I will be paying 10. I will just increase it by 10%. I will increase this one, 55 by 10%. So it means I will be increasing it by 5.5. So that's the implication of the growth. So if you are paying 50 this year, then next year you are going to be increasing it maybe by 10%. And that 10% is going to be fixed throughout. So what is going to be constant is only the rate, but not the amount that you are going to be paying out. So that's the difference. So the examiner will actually give you the data. He will give you data maybe for 3 years or 4 years. Then he will ask you what type of dividend policy are they applying. So for you to be able to know which type of dividend policy they are applying, you must do the analysis, you first make the computation to be able to know whether it is a constant growth or it is a constant dividend. A constant dividend is just the amount I'm paying $50 throughout. Every year, $50, $50. They will also give you that information. So constant growth, it is going to be increasing, but the rate is going to be constant. We are increasing whichever amount it is by 10% throughout each year, each year, each year. So it is just constant, but it's the constant growth in dividend. So the examiner may ask you whether it is constant. Say, is it a constant growth? Is it depending? The other that we can talk about, number 3, because I told you there are 5. Number 3 is what we call constant payout ratio. Constant payout ratio. Constant payout ratio. Now, for constant payout ratio, we have what we call a constant payout ratio. But it is a little bit different from what we know. The number 1, the constant dividend, it is a little bit different. And I would prefer, of course, I would prefer this third one, the constant one, the constant payout ratio. What is going to happen is that, because if let's say we pay 3%, and then when we have performed badly, you will still get this 3%. If that's the rate we are paying, we pay 3%. If we have performed badly, if let's say today, year 1, we have made 1 billion. 3%, that will be 300 million that you will get. This is 1 billion profit after tax. Now, what will happen when we perform better? Of course, this is where this was our worst. Now we have performed, we have good performance, but the rate is still the same. But now we have made in year 2, we have made a profit of, let's say, 2 billion. But we are still paying 3%. So it is going to be 3% of the 2 billion. It will be 600 million. Are you seeing this amount? It keeps on growing, even though the rate we are paying is constant. It's different from the other one where we are only paying $50, the constant dividend. We are paying $50 whether we have made 10 billion in profit after tax, whether we have made 1 billion in profit after tax or 500 million, we pay you that per share. So as a business person, of course, you would prefer the constant payout ratio. So you'll find yourself that the amount you are going to be receiving is going to be keeping on increasing throughout the year. So let's look at number 4, the fourth one. The fourth one is dividend as a residue. As a residue or residues. In other words, dividends as residues, it means they are paying you what has been left. So this is very popular over different people. Like I've told you, someone has an investment of, let's say, 2 billion. They come and they have made maybe profit after tax of, let's say, 3 billion. So what they do, they first take care of their investment of 2 billion. Then what has been left is what is going to be distributed to the shareholders as their dividends. So that's what we call paying dividends as residues. Like you pay on what has been left out. So that's also a dividend policy a company can adopt. So most of the CFOs, they adopt this because it works for them. For them, their issue is to manage funds. they don't want to go and borrow. Once they go and borrow, of course, they are bringing in debt, and they know its impact. So what they do, they retain the profit that has been made so that they can use it to plow back into the business or to make other investment for the business to be able to make more money. Of course, everyone would want that, but as the shareholder, their main aim is actually to earn dividends. So if I'm the shareholder, my primary interest is to actually get the dividends. So if you tell me you have made an investment, even though I'm going to be earning more profit, but at the end of the day, the decision is theirs to know, like to tell whether they are going to give dividends or not. So this is most preferred by the different CFOs because this works for them. They don't have to look for more money from other different sources that may be expensive. The last one, of course, the last one is not paying dividend at all. No dividend. No dividend. You can decide, it's a policy. Someone can have, for us, we have a policy for 5 years or 10 years, we are not paying any dividend. No dividend at all. It can be a policy, and companies are adopting it. So those are some of the things that I wanted us to look at as far as the dividend payment policies are concerned. So I want us to look at the last item for this topic, and that last item is all about the dividend capacity. We want to understand the dividend capacity, because for dividend capacity we have some computations. We have even a format. We are going to have a look at the format that we are going to use for dividend capacity. So this is one of the last part that is a little bit computational in nature. So the dividend capacity. So that's what we are going to see, the dividend capacity. Now, of course, where we are heading now for the dividend capacity, it's an area that I've never seen as far as CPO questions are concerned, but we don't know. But it is more in the SCCA papers. So we needed to look at it. It is very easy thing, but mostly examined in SCCA papers, and it will never be theoretical. It is always a computational number, and the examiner might give you a balance sheet or a trial balance. So whichever statement the examiner has given to you, you'll be able to draw what we need from those statements that have been given to you. Now, what do we mean by dividend capacity? The word dividend capacity means how much money are you going to pay for dividends. In other words, which figure are you going to pay? Like which figure are you going to pay as dividends? Are you going to pay out as dividends? So that's the figure that we are trying to look at, and that's why I'm saying it will never be theoretical. It is always a computational part, because we are trying to look at which exact amount are we going to be paying out as dividends based on the profits that we have made for a given financial year. So if, for example, if let's say you have made 9 billion, this is profit after tax. You have made 9 billion profit after tax. Then the question is, how much are you going to pay out as dividend on these 9 billion that you have made? Are you going to give it out all of it? because this is profit after tax, but it's not exactly what we give out. They might tell you that this is the profit after tax, but when in actual sense, they have given you a different profit after tax. So you have to be careful which profit after tax have they given to me. So the figure that we are looking for is the figure that we are going to be paying out as dividend, the whole dividend amount that we are going to be distributing to our shareholders. Now, one thing I want you to understand is that the dividend decision of a company, dividend decision, the dividend capacity, sorry about that, the dividend capacity of a company, of any company, is what we call the free cash flows. Free cash flows to equity. They abbreviate as FCFE. Free cash flow to equity. However, in our financial statements, we always prepare, we have two types of cash flows. We have this first one, the free cash flow to equity, and at the same time, we have what we call the free cash flows, which is abbreviated as FCF. Now, what's the difference between the two? Free cash flow to equity and then the free cash flows. Now, free cash flows, that is the money that is available for the company to distribute to both equity participants and then the debt participants. So free cash flow to equity is always available for both debt holders and the equity holders. So this free cash flow, that is the money that is going to be available for distribution to both the debt holders and then the equity holders. In other words, you distribute to your shareholders and you also distribute to those people that gave you loans, whichever kind of debt finance it was. So that cash flow is what we call the free cash flow, is the one we distribute to all. Now, the free cash flow to equity, in other words, when we are determining the dividend capacity, we look at the free cash flow to equity, which is the money available to be distributed to only, this is only equity participants or equity shareholders. Free cash flow to equity is available to only equity participants, those who have bought ordinary shares or what we call common stock. So the examiner might give you data that is a little bit maybe mixed up, and maybe is just trying to confuse you a little bit. But what you need to do is you need to arrange so that you can be able to compute what you call the free cash flow to equity. And that free cash flow to equity is what we call the dividend capacity. So how do you separate free cash flows to the firm? Of course, this free cash flow to the firm means that is the cash flow that is available to both equity participants and then the debt participants. So how do we separate the free cash flow to the firm and then free cash flows to equity? So we can have a format. Let's show a format for dividend capacity computations. Format for dividend capacity. So the story begins when you have free cash flows to the firm, which is the money that is available to all the debt and then the equity holders. And immediately you expense what we call interest. then it means that the debt holders have been paid off, and what is available is money that is available for distribution to equity holders. So what we start with the profit before interest and tax. The profit before interest and tax. So we take it there. This profit before interest and tax is what we call the operating profits. Let me put it here, operating profit. That is the operating profit. Of course, on this amount, we add back non-cash items. Add back non-cash items. Non-cash items like depreciation and amortization. They are supposed to be added back. Then we less investment in non-current assets. Investment in non-current assets. And here we take the increase. The reason why I'm putting the increase is because we are lessing off. Remember, what we are trying to do, we are trying to arrive at the cash that is available. So the non-cash items are supposed to be added back because they don't involve into what we call cash movement. Then the other, we are supposed also to less investment in working capital. Investment in working capital. We take the increase also. If there is a decrease in working capital, then that one is supposed to be added back. So this one is supposed to be deducted also. And then we less also the tax. We take off the tax. And once we take off the tax, what we are left with is what we call the free cash flow to the firm. That is the free cash flow, or what we call the FCF. That is the money that we are left there. Free cash flow. Now, once we go to the free cash flow, it means this is the money that is available to both the equity participants and then the debt participants. So what we do, we go back and take off the interest. So this is where it starts. We less off, less interest expense, whichever amount it is. Once you take off the interest expense, it means you have paid the debt holders. Now, what you have left with, the figure you have left with is what we call the free cash flow to equity. That would be the figure. So this is FCFE, free cash flow to equity. And that's the figure. This figure here is the money that is supposed to be paid as dividends to the shareholders. So the question will be, what is the policy of the company? Are they going to be taking a constant, because this is what is going to be declared as money that is available to the equity participants. Once you have declared, then the question is, how much are you going to be paying per share? Are you going to pay using a constant dividend? Are you going to pay using a constant growth? Are you going to pay using... So once you have allocated all the money to the different shareholders using the dividend policy, you are not going to apply all of them. You pick one, then you apply that. You can change it when you need to. So once you are done, of course, you go the other payment, whether you are going to pay the payment methods, whether by cash, split dividend, bonus issue, scooped dividend, and others. So now someone is going to be wondering, why are we adding back the depreciation here? The non-cash items. We are saying that these non-cash items are supposed to be added back. Someone may be wondering, why are we adding back depreciation? Because we know depreciation equals the amount It equals the amount of reinvestment needed to be made, like to be maintained. Like you try to keep some money aside to make sure that at the end of the day, this asset like you can use the asset, then at the end of the useful life of the asset, you can be able to buy another asset, same asset. So the depreciation is just the amount you keep it aside, but it's not a real expense that it is going to involve in cash moving out of the business. So you maintain, it is an expense that is going to help you maintain the current productive capacity. In other words, in the question, if you see depreciation of, let's say, 40 million, and somewhere in the question, the examiner says that we need 40 million to reinvest in assets, then don't add it back. Like, you don't add back depreciation because it's money that you have set aside, but you need it for reinvestment. So you look at the notes that they have provided. Then the other thing that we can conclude with is the fact that we had looked at some ratios earlier. We looked at some ratios, those were market ratios, and we've said that the examiner can tell you to comment about them. Some of the ratios that we looked at dividend per share, because what is going to happen is that the examiner can tell you to comment on the dividend policy of the company. What are you going to do? Of course, when you are commenting, you use some of these ratios. So if an examiner tells you to comment about the dividend policy of a company, then you could be forced to do some ratios like the dividend per share, like the dividend payout ratio, and others. So we can have some formulas just to highlight as we close this one off. So dividend per share, sometimes it is abbreviated as DPS, dividend per share, which is the formula is dividend declared or paid. Because once the dividend has been declared, even if they have not paid it, they will pay over number of ordinary shares. 2, the other ratio, this is the first one. The second ratio you can comment on could be the dividend payout ratio. Dividend payout ratio. So the formula for dividend payout ratio is, of course, dividend declared over, you can use profit after tax, or what we call the earnings after tax. The other, you can also use it could be in a percentage, or you can use dividend per share over earnings per share. It could be per unit or per share times 100. Then of course we have the last one. Maybe you can talk about the dividend yield. Number 3, dividend yield. Those ones could be enough. The dividend yield, of course, it is dividend per share over the market price per share times 100. So that's all that we wanted to look at as far as capital structure and dividend policy are concerned. So one of the topics that we are going to look at next, we are going to start with our portfolio theory. Portfolio theory, or what we call portfolio analysis. Portfolio theory or analysis. It's a very good topic that we don't look at in our level 2, But here on level 3, it's very big topic that we do so many computations, and it has more of computations than theoretical aspects. So that's what we shall begin with when we are continuing with other series of advanced financial managements. Thank you for watching. Endeavor to subscribe. Make sure you share to your colleagues and friends so that they can be able to have the same benefit that you have received. Thank you. Hello viewers, welcome back to our YouTube channel, KC Accountants Education Center. Today we want to proceed with our topic of portfolio theory, and in the previous video we had covered the introductory part, and we had promised that we are going to look at the statistical concepts that are used. These are statistical methods. In other words, the methods that we are going to be using in computation of the portfolio theory are statistical methods. So we are going to get the statistical concepts that are used in estimating risks and returns. We are starting with for a single asset. So you have to note that, as I said, we are basically focusing on the single asset. We want to start with a single asset. Remember, we said a single asset is not a portfolio. Single asset, we said single asset means you are dealing with only one line of business. So these formulas, they differ. The statistical methods that we are going to look at, they differ as when you are looking at a single asset and then when you are looking at a portfolio. I explained what a portfolio is, and I said for a portfolio you have more than one assets, or you are dealing in, the investor is investing in more than one line of business. So we need to look at how do we measure returns first. How to measure returns. Because I told you we are specifically looking at risks and returns. How do we measure returns? One, we can use what we call the expected returns. In statistics, they call it the expected mean. But here we look at it as expected return. So I'll abbreviate as RA, or others can abbreviate it as E into X bar. So whichever the abbreviation is, just know what it is. The formula for expected return, what we call the E into X bar, is equaling to the summation of P R J. Let me just use letter J, where of course everything here is going to have letter J. Even this one is going to be having letter J. Just to show, you can call it letter J, you can use letter J, you can use letter I, whichever, as long as you define. So RJ is the return for the first probability, for the first possibility. Let's use possibility. Then Pj, of course, it is the probability of occurrence of that return. Which return? We are talking about this Rj. So the probability of that return, and this Ex, x into E into X bar, or what we call the Ra, I've told you this is what we call the expected return of asset A. Let's just of a given asset. Of course, I've used the Ra, which means this letter A is representing asset A. This Ra that you are seeing here is just showing this R means return. This is asset. Return of asset A. That is the implication. So that's the formula. It is just summation Pj times Rj. So this is the formula that we are going to be using throughout when we are computing expected return for a single asset. That's why here we are saying asset A, only one asset. So we need now to add the returns depending on how the state of nature is. Of course, what is going to happen is the fact that in the exam they are going to give you the returns of, let's say, year 1, year 3, year 2, year 3, year 4, whichever years they have given you. They also give you the probabilities of occurrence. So you will just be multiplying the return times the probability. Return times the probability of those different years. Then after that, you add them up, because they will be asking you the expected return of that project. Remember, the project can be for, let's say, 5 years, but they have given you returns of each year. So you multiply by their probabilities, and then you sum up the result to get the expected return for that asset for the entire useful life of the project. So what you do, we just keep on adding the returns depending on the state of nature. So once you do that, then you will multiply by the probabilities so that you can be able to get the expected return, and that's how we compute the return of a single asset. So more so when you're doing, of course, when you're doing return, it's more of someone computing mean, which is the average. So now we need to know how can we be able to compute, how to compute, or how to measure risks. How to measure risk, but this risk is for a single asset, one asset. The other one we looked at return of a single asset. So now here, of course, we know that risk is measured using standard risk is measured using standard deviation. Standard deviation, it has that the symbol is like that for standard deviation. Other just write it as D like this. So that's the symbol for standard deviation. But we know mathematically we don't have any formula for computing standard deviation. So what we do, we compute variance. We just get the square root of variance. So we know it will be just the square root of variance. So for us, we shall be computing what we call variance. Once we have variance, then we, of course, it will be the square root. We know that from this is going to be the squared, because we are just going to square. We know standard deviation is the square root of variance, but for us to be able to get variance, it will be standard deviation squared, or you can just use SD squared. But we know that standard deviation is the square root of variance. Of course, if you cross multiply this, you take the square root, this one will take off this, you will remain with your D. That's where it comes from. So the formula that we are going to be using is going to be standard variation equals the square root of variance. And the good thing, we know the formula for computing variance. Mathematically, it is known. So variance, since we've said that standard deviation SD is the square root of variance, but we know the formula for variance. So it will be, we know that variance equals summation P into RA minus RA bar squared, or others they call it summation P into X minus X bar squared, where X is the return, or what we call the mean. X is the return, this X here, but this X bar is now the expected return, this X bar here. In other words, there is no way you will be able to compute standard deviation minus first computing the expected return, because the other figure is going to be feeding in here. So if you look at this first one, this RA is what we call the return of asset A, return of asset A. Then this is, of course, the expected return of asset A. This P is the probability. So that's the formula. Of course, you just take all this. If you want to get the standard deviation, it will be the square. You take the square. I've put in this squared here to show you that it is actually, because we've said that variance equals D squared, standard deviation is squared. So the standard deviation is just going to be SD will just be equaling to, we'll take the square root summation P into X minus X bar squared. So this is the formula that we are going to be using to be able to compute what we call the risk of a single asset. So someone is going to be wondering, how do we make a decision after making the computations? Let's say we have put into the formula, let me just use something small. When we are using risk and return, how do we make a decision? It is very important that we get to know that. Let me just use a small diagram here. If I have asset A, let me just have an illustration on how we conclude. Now, of course, when you're using, now we want to use both. We want to use risk and returns to conclude. Return at once. Once we have these two, let's just take this as an illustration. We have some assets. Let's say we have asset A and then asset B. Then we need to make a choice. So we have here, we have the risk. The risk here is, let's say, 40%. And here we have, let's say, 28%. Then return, we have here, let's say, 62%. And here we have 69%. If we have that as our answers that we have got from the computation, the question is, how are we going to make a decision? Which of these investment ideas are we going to take? If we have computed our risk in asset A is 40% and the return is 62. So how do we make a decision? So if you say that the risk of that single asset, the risk of this single asset is 40%, as we have seen, and the expected return is 62 for this asset A. So the question is, how are we going to, but if you look at the asset, this asset B, if you look at this asset B, we have what? We have the risk is 28%, but the return is now 69. You are seeing this one is more than this one. So the question is, how do we make a decision that we should invest in this kind of business? Because I told you that when you're dealing with a single asset, you are only going to be looking at the risks and the returns. You have done your computation, you have got the risk, you have got the return for each item. The question is, how are we going to make a choice? Which item are we going to be taking into consideration? So if you are using both risk and return to make a decision, then you will choose to invest in asset A, this asset A here. You will choose to invest in this asset A. We shall choose asset A. Why are we choosing asset A? Because we said that based on risk and return, we said that we are going to take asset A because it has the highest risks. The assumption is that the investment idea that has more risks, it is expected to yield more returns. It doesn't look about, you don't consider the returns to make a decision. but you look at that investment idea that has more risks. It's what you should choose, because by using risk and return, they assume that a business that has a higher risk has a higher potential of generating money. That's the assumption. So the investment analysis tool we use here to make a decision, we have what we call the mean to variance analysis. Mean to variance analysis. Let me just write them here as our conclusion or advice. Can take it as advice, because I remember I told you we are not just going to compute. So what we do when we are using risk and return, the method that we use to make a decision, we have what we call the mean to variance relationship, or what we call, you can call it risk return relationship. So the risk return relationship assumes that the higher the risks, the higher the expected returns. So it assumes, this one, it assumes that the higher the risks, the higher the expected return. The higher the expected return. And that's why we chose to go with asset A in this illustration, because it had a higher risk of 40%. This one had 28. We don't look at the return. Even if the return here is low, this is 62 and this one is 69, we go by the one that has a highest return. So that's how we make a decision. We use what we call the mean to variance relationship, or risky return relationship. That's one tool. But we also have another tool. We have another tool that we can use. That's one tool. This is tool 1 for making advice. But we also have a second tool. The second tool is what we call the coefficient of variation. Coefficient of variation. And we know the definition of variation. The variation. Variation is also a measure of risk. Is a measure of risk. And the coefficient of variation is always given by the formula. The coefficient of variation is always given by the formula risks over expected returns. Or you can call it the standard deviation over the expected return. Because we said that the measure of risk is standard deviation, that's why we are changing it. So you get the other figure that you've got on the other side, and then you substitute them here. If you are to compare this table here, we are seeing that asset A has risk of 40%, then a return of 60, then asset B 28, then the 69. Then we can substitute into this formula for us to be able to compute the coefficient of variation. So if you base on that, remember we chose asset A. Let's first look at asset A. Now asset A, the coefficient of variation is equal. The other one had 40% risk, then 62%. So it will be 40% divided by the 62%. So it is 40% divided by 62%. So this will give you 65%. They are all in percentages. So that is giving you 65. So we look at asset B. For asset B, the coefficient of variation will be, now we pick the values. This one has 28 and 69. So it will be 28% divided by the 69. So this is going to be 28% divided by the 69%, and this will give you 41%. Now, how do we make conclusion? This is the conclusion, or what we call the advice. When we are basically using the coefficient of variation. So we can just put it in a table. So we have the assets. This is asset A, this is asset B. The coefficient of variation, then we can put the choice here. This one gave us 65%, this one 41%. So those are the coefficients that we got. So the decision point for these two, the decision point is that we depend on the results that we've got for these coefficients. We say that coefficient of variation is the measure of risk. So now, if we are measuring risk, then we should anticipate that the lower the risk, the better for the business. The lower the risk, because coefficient of variation itself, it measures risks. So for the business to be safe, the risks are supposed to be lower. So the lower, how you make a decision, you look at the lower. The lower the coefficient of variation, the better. The lower the coefficient of variation, the better. So from this project that we are seeing these asset A and asset B, which one has the lowest coefficient of variation? So you are seeing here, we shall go by project B because it's the one. So we shall take asset B because it has a lower coefficient of variation of 41%. So B will be chosen. So we shall go by asset B if we are basically looking at the coefficient of variation, because it's the one that gives us the lower coefficient of variation. So we need to be careful when you are making these, when you are looking at these formulas. Now, remember we have been looking at single asset. We have not looked at a portfolio. So we are concluding that when you are dealing with a single asset, or what we call one line of business, if you are going to go into banking, you go into banking. If you are going to go into communication, you go into communication. Not being in communication and at the same time you are in the beverage sector. So Once you are dealing with a single item, if you look at the question and you see that you are dealing with a single item, then you can compute what we call the risk associated with that single asset, and then you also compute the risk associated with that single asset, and then you also compute the return for that single asset. These are the things that I spoke about when we were starting. And after computing the risks associated with that asset, and also computing the expected return of that asset, then you choose, and the criteria for making the decision is either by using mean to variance relationship, or by looking at what we call the coefficient of variation. So that's how we measure risks and returns of that asset. And we said that if you are going to go by the mean to variance relationship, then you should take that investment asset that has the highest risks. If you are to go by the coefficient of variation, then you should look at that investment idea that has the lowest risk. Of course, the lowest risk, we know that coefficient of variation measures risks. So this one will be the lowest coefficient of variation, because coefficient of variation is a measure of risks. I hope you can be able to get what I'm referring to. So what we are going to look at in the next video is going to be the determination of risk and returns, the risks and expected returns, and the portfolio. So we are going to be looking at determination of risks and expected returns under portfolio theory. So here we are going to look at how do we compute, because we said that in all these aspects we compute what we call expected return and then the risks associated with those assets. So let's meet in the next video as we are talking about the determination of risks and returns under the portfolio theory. We see you there. Hello viewers, welcome back to our YouTube channel, SC Accountants Education Center. And today we want to proceed with our series of advanced financial management. In the previous video I talked about dealing with a single asset, and we tried to look at the statistical concepts that we use to be able to compute the risk and the expected returns. And we had promised that we are going to look at the determination of risks and the expected returns under the portfolio theory. So determination of risks and expected returns under portfolio theory. So we are now looking at portfolio, and when we are looking at portfolio, it means we are looking at two assets or an investor investing in more than one line of business. So the examiner can give you different investment proposals. The examiner can give you, let's say, can give you a school, can give you shares, and he can also give you, let's say, bonds. So these are different investment projects. You can decide to invest in a bond. You can decide to invest in shares. You can decide to invest in a school. Let me change this bond, let's say, to a pharmacy to be a little bit different. This is a pharmacy. Now the examiner will be interested in knowing how can you be able to choose which investment project you should undertake. Remember, we said there is no way we can compute risk and expected return for a portfolio that exceeds 2 investment projects. Now we are seeing that here we have a school, we have shares, we have also a pharmacy or a pharmaceutical business. So if you have 3 business ideas that you want to invest in, if we want to look at the risk and return as far as the scope of advanced financial management is concerned, we are going to specifically look at only 2 investment projects. But now you are seeing that the examiner has given you, he has given you 3 projects. So we are going to formulate what we call the portfolios. You can either decide that you are going to invest in a school and shares, or you are going to invest in a school and a pharmacy. So it means there are going to be 2 investment projects. So once they have given you these 3 portfolios or single assets, because each of these is a single asset, you can invest in a school as a single line of business. You can invest in shares as a single line of business. But we've said that once you are dealing with a portfolio, it means these investment projects are more than 1, but they don't exceed 2. So we are trying to compute the risk and return associated with each of these individual items. And that's why we are trying to form a portfolio, because these 3 projects can't be executed at once because we don't have a statistical method that we can use to compute risk of a portfolio that has more than 2 projects. 2, we don't have a method that we can use to compute risk of a portfolio that has more than 2 investment projects. That's why here the first thing we do, we first formulate the investment projects. In other words, we first form the portfolios to be 2. And I said you can choose to go by maybe a school and shares. The other, you can decide to take a school and a pharmacy. Or you can go by taking shares and the pharmacy. So those are the different portfolios that we can have. Meaning, if you have those 2, you can either say, I'm going to invest in a school and shares, or I'm going to be investing in a school and a pharmacy, or you can invest in shares and a pharmacy. So it means we are going to be having 3 investment projects. These are 2, these are 3. But each investment project forms what we call a portfolio. So we need now to know what is the risk and return, the expected return for each of these portfolios. And that's what we are basically want to compute. So once you have formed these portfolios, then you can go ahead and substitute into our different formulas, the statistical formulas that we have. So the question, if the question, let's say, is looking at different portfolios, because one way the examiner can give you the different investment projects and it will be you to form those portfolios. The other way is that the examiner can set for you the different portfolios that you can use to make the computations. So once we have formed our portfolios, then we go ahead and compute the expected risk, the expected return, and then the risks. So how do we compute the expected return of a portfolio? Expected return of a portfolio. In other words, when we have 2 investment projects. So we've seen previously, we saw the expected return is actually E into X bar for the single project to a summation W RW, but this R bar. So that was this was just the probability, and this is the return. Or this one you can call it the weight. Of course, you can also just put I equal to 1 per n. But now, since this was for only one item, one asset 1. But now, once we are dealing with 2 assets, the formula changes. 2 assets, or what we call a portfolio. The formula changes slightly. So the expected return of a portfolio, I'm just going to call it RP. Expected return of a portfolio will be, this is WA, weight A, RA bar plus weight B, RB bar, where the WA is actually the weight of asset A, weight or probability of asset A, of the asset A. Then this RA bar is actually the expected return of asset A. Then the WB is actually the weight of asset B. Then RB bar is the expected return of asset B. So that's the formula that we use to compute the expected return of a portfolio. We just sum up the expected return of asset A plus the expected return of asset B. We just sum them up. Once we add them, then we get what we call the expected return of a portfolio. This is the formula that we've been using for computing the expected return of a single asset. So you just sum up. But when we go to computing the risk of a portfolio, the formula is completely different. So let's look at how do we compute risks of a portfolio. This is now the formula for computing risk of a portfolio. So the problem is actually on this risk of a portfolio because the other one is a little bit easy. We know that for us to compute risk, we need to be knowing the standard deviation. So we know that risk, the measure for risks are measured by using standard deviation. But now the standard deviation of a portfolio will be equaling to the square root. This is weight A squared times standard deviation of asset A squared plus the weight B squared times standard deviation squared of asset B plus 2 weight A dot standard deviation A for asset A times standard deviation of asset B times, this is lambda A comma B. The whole of this is under square root. So that's the formula that we use. Now we need to define all these. So here we are adding, even here we are adding. So this is, the whole of that is we multiply it, even this one, where, of course, we know that this represents the standard deviation of a portfolio, this one here. So we are going to define each of these: weight A, weight standard deviation A, weight B, standard deviation B. This is weight A, standard deviation A, standard deviation B. This is lambda. The whole of this is representing one item. So let's continue. This is weight A squared is actually weight of asset A squared. Weight of asset A squared. Then D, of course, this is standard deviation squared A. This one is standard deviation of asset A squared. Then WB, WB is representing the weight of asset B, asset B squared. This is WB squared. Then standard deviation B squared. This is standard deviation of asset A of asset B squared. Then WA is actually the weight of asset A. This one is not squared. Then WB is the weight of asset B. Then we have also standard deviation of asset A. Standard deviation of asset A. Also have the standard deviation of asset B. These are not squared. And then this lambda here is the one that represents the coefficient, the correlation coefficient. This one is representing the correlation coefficient. This is correlation coefficient of, it is actually correlation coefficient between asset A and asset B. So it is between A and B. So that's the formula. And this formula is also provided in the formula sheet. It's the one that we use to compute. The whole of this is correlation coefficient of asset A and asset B. So we need to look at how do we determine the correlation coefficient of asset A and then the correlation coefficient of asset B. So this same formula, it has been given in the formula sheet, but for it they wrote it as SP equal the square root. This is W small a S squared, WA squared, S squared plus WB squared, SB squared, this is SA, plus 2WA times R, of course this is lambda AB, times SA times SB. These S, they represent the standard deviation. This is standard deviation of asset A. This is standard deviation of asset B. This is weight of asset A. This is weight of asset B. The whole of this is the correlation coefficient of us between A and B. This is weight of asset A. Of course, this one has there's also the weight B. This is weight A times weight B. So that's how it is written. But as I told you, this RA B, it's also a symbol to represent a lambda. Is the correlation coefficient between asset A and B. So it means that this lambda A is also the same as, you can write it that way, which is the same as correlation coefficient. So it means the same thing here. So we need to understand how do we compute the correlation coefficient. So for us to compute the correlation coefficient equals to convariance, between A and B, convariance of A and B divided by standard deviation A times standard deviation B. So S standard deviation A times standard deviation B. Or in some other books, they write it as conv, but it means the same thing because it's just a short form of convariance. They use conv A B over the standard deviation of asset A times the standard deviation of asset B, where the conv A to B is the convariance of A and B. Then, of course, this represents the standard deviation of A and B. In other words, you can call it standard deviation or risk because we know the measure of risk is what we call standard deviation. So this is risk A, risk of A. Then, of course, this is risk of asset B, or the standard deviation of asset B. But now we have seen that we have also introduced in a new term, this convariance of A and B. So how do we compute the convariance? So for us to compute convariance, or what we abbreviate as conv of asset A and B is represented by summation P into, let me just put it down here. This is conv A and B. So this one is represented by summation P into RA minus RA bar into RB minus RB bar. In other words, where this P is actually the probability of receiving these returns. P is the probability, this one is probability. So this RA is the return. This one is representing the return. Then RA bar is representing the expected return. Then of course even this one, expected return of asset A. This is the return of asset A. So this one is representing return of asset B. This is the expected return of asset B. So mathematically, the convariance is written as conv into xy, which is equivalent to summation P into x minus x bar into y minus y bar. We know that this is actually the expected return of asset X. This is the expected return of asset Y. So this is the probability P. Then this is the return of X, return of Y. So whichever way they have expressed it, that's how we explain it. So we've seen that for you to be able to compute the risk of a portfolio, you need to understand there are very many formulas that are going to be involved The first one, they have given us the exact formula for computing the risk of the return. But within the formula, we have seen that we have got two extra items that need separate formulas. So for you to be able to compute the risk of a portfolio, you need to first know how to compute a correlation coefficient. And this correlation coefficient also brought something new, which is the convariance. So there is no way you will get the risk of a return, the risk of a portfolio, if at all you have failed to compute the correlation coefficient, then the convariance, because these two, they are the ones that are feeding into the final formula that you are going to use to compute the risk of a portfolio. So those are the different formulas that we have as far as computation of the risk of a portfolio is concerned. The one for a single asset, that one was very easy, because for a single asset, we said we just look at the coefficient of variation, and then we look at the standard deviation. There were only two methods, but here the methods are two. The methods are more than one, because you are going to be using more than two formulas to arrive at the risk of a portfolio. But now we need to understand, how do we interpret our results? Interpretation of the results. In other words, what are we interpreting? We are interpreting expected return of a portfolio, and also we try to interpret the risk of a portfolio. So we need to understand the answers we have gotten. You are not just going to make computations and you leave them there. We need to make, like, we need to comment and give advice. So that's what we are going to look at in the next video. We try to look to understand, how do we comment when we have, let's say, a convariance? How do we comment when you are looking at correlation coefficient? Then finally, how do we comment when we are using the other on the results that we have gotten on the expected return? Because the expected return is going to give us a different answer that will feed into the computations of the risk of a portfolio. But in each of the two, we comment differently. So we are going to look at the different ways of how we can comment basing on the formula that we have used to compute these two aspects. Hello viewers, welcome back to our YouTube channel, KC Accountants Education Center. Today we want to continue with our series of advanced financial management. And in the previous video, we had looked at how you can be able to estimate or compute the risk and expected return of a portfolio. We looked at different methods, and we want to conclude with the aspect of how we can be able to interpret the results. So interpretation of the results. Interpretation of the results using portfolio theory. So we had looked at the aspect that we had formed our portfolios. So I'd looked at having a school and shares, having a school and a pharmacy, having shares and a pharmacy. So just assume that these are the three investment ideas that we have. But just know, as an investor, you need to select one portfolio of the three. So we have investing in a school and investing in shares as our first portfolio. Then the second portfolio is a school and a pharmacy, then shares and a pharmacy. Now, we looked at the different formulas that we can use to compute the expected return and then the risk. But now, once you have used those different formulas, we can use convariance. We can use convariance to make decision whether we take up this investment project or we take up the other. So we can use convariance to determine which portfolio we should go with. So not forgetting that we had already formed our different investment portfolios. And all of these three investment portfolios that we had formed, we compute the expected return for each of those investment portfolios. Then we see how we make a decision basing on the results that we have gotten from the different computations that we have done. So the examiner is going to be telling you to advise whichever company or whichever investor they are dealing with in the question on which investment project they should undertake. We also saw from our previous videos that we can use mean to variance relationship. Mean to variance relationship. We can also use it because we used this under the single asset or one line of business when the investor is only investing in that one line of business. We can also still use it here under portfolio. But the only way or the only option that you have for you to use mean to variance relationship under a portfolio analysis is only when the examiner has told you to use mean to variance relationship. So if the examiner doesn't tell you, if the examiner doesn't specify that you use mean and variance or mean to variance relationship, then you shouldn't use it because it is a little bit limited. It can give you unrealistic results if you base on its assumptions. Meaning when you have, because now if you are to go by the mean to variance relationship, you compute the expected return of a portfolio and then you also compute the risk of that portfolio. If it is portfolio 1, you compute the expected return of that portfolio and then you compute the risk of that portfolio, and then you see which one has the highest risk. Because with the mean to variance relationship, we expect that the higher the risk, the higher the returns. That's the assumption. So you look at which portfolio has provided me with a higher risk percentage. Of course, we computed this and we converted them to a percentage. So which one is giving me a higher percentage of risk? You don't look at the return. Even if the investment has 100% return, but its risk is, let's say, 5%, we take up the other investment which has a higher risk, because that's the assumption of mean to variance relationship. So you look at the expectations are higher returns, as they are going to come as a result of higher taking up businesses that have a higher risk. The other that we used in the other side of single entry, we used what we call the coefficient of variation. This one we also looked at it under the single entry, but we can also use it here to make a decision. So these two, we used them when we are dealing with a single entry. And the coefficient of variation for it looks at that investment project that has the lowest coefficient of variation. But these two, we only use them when the examiner has told us to use them, because these other methods, using convariance or using the correlation coefficient, they give a more realistic figure. It can enable someone to make a reliable decision because of the results that they are providing. So once you have the convariance and you also have the correlation coefficient, it's better you make the decision basing on the results of those two. So we need to see how do we make a decision basing on convariance or basing on correlation coefficient, because they are the ones that are giving a more realistic figure. So let's begin with convariance. How do we make a decision? Now, convariance, it shows movement. It's more of movement or spread. It shows movement. Now, the answer could be a positive convariance, or it could be a negative convariance. So if you are going to be using convariance to make a decision, then you are going to select that investment portfolio that has a negative convariance. So the portfolio that has a negative convariance is considered to be better. So if you get a positive convariance in one portfolio, then it means that that portfolio is not good for investment. So the best option is for you to take the one that is giving a negative convariance, because it will be good for making that investment. Because someone is going to be wondering, how is it going to be good if at all I've computed the convariance of a portfolio and I've gotten a negative convariance? The argument here is that these remember we are selecting two different projects. It's going to be either, let's say, a school, maybe an investment in shares. So these two projects are going to be moving in opposite direction. So we are going to have an opposite movement. If this one is going this side, then this one is also going to be going the other side. They are not moving in the same direction. They are moving in opposite direction, because I told you that convariance only measures movement. Is it going in the opposite direction or it's moving in the same direction? So if let's say this school makes a loss, because you have a school and it has made a loss, the implication is that the other business will not make a loss, it will make a profit. That's the kind of movement that we are talking about. That if this company makes a loss, the other one makes a profit. Remember, we are taking two investment projects. If investing in a building will make a loss, then investing in other, let's say in a school, it will be profitable. So there is opposite movement. They don't move in the same direction. But for a positive convariance, it means that they are moving in the same direction. The implication is that if I have decided to invest in a school and at the same time I'm investing in shares, once I make a loss in a school, I will also make a loss in shares. That is when you have gotten a positive convariance. That's why it is better if this business is making a loss, the other one is making a profit, because the other profit will compensate the loss that you have incurred the other side. That's why it is better to take up the portfolio that has given you a negative convariance. So that's the difference. If you are to look at which portfolio should I take basing on the convariance that we have computed. So now we want to look at the correlation coefficient. How do we make a decision based on the correlation coefficient? So we know from statistics that these are just they are more like probabilities, but these ones we can have negatives. The only difference is that we can have some negatives. So the general rule is that for the correlation coefficient of the two projects, it should be greater than or equal to +1, but less than or equal to -1. In other words, it shouldn't go below -1 and it shouldn't exceed +1. So it is just in between there. So the question is, what is going to be the best option? So it is also going to have a positive, it can give you a positive, and at the same time it can give you a negative answer. So if we get a positive answer, what is the implication? But the bottom line, it shouldn't exceed 1, either -1 or a +1. It shouldn't. So if you see that it is actually exceeding that range, then you just know you have just made some errors. So it is going to be moving in a sense that we can move from 0 to the negatives. Maybe we can have, let's say, -0.5, then this is -1. Here we have +0.5, then +1. Now, how do you make a decision? Of course, this is going to be negative correlation. Here we have a negative correlation. The whole of this item here is a negative correlation. So the whole of this side is going to be showing us a positive correlation. So even within this, if it is maybe -5 going to -1. This one is going to be strong negative correlation. If it is between -0.5 to 0, then it's going to be weak negative correlation. Once it is in between 0 to 0.5, that is positive. It is weak positive correlation. So if it is positive 0.5 to 1, then it is going to be a strong one. So it depends on the answers that you have gotten. So of course, with our advanced financial management, the basis on whether the result is a positive or it's going to be a negative, that's where we put our emphasis, to have a positive or to have a negative. But now, we don't go into deep analysis of whether it has given us a strong negative correlation or it has given us a weak correlation, but we are just taking the general picture. Is it a positive correlation or it is a negative? That's it. But if you understand the whole argument of whether you have a strong and a weak, you can explain it in your comment. That even though it is a negative, but it's a negative, but it is close to -1, so it is a strong one. So for us, we just look at, have we gotten a negative correlation or we have gotten a positive correlation? And of course, a proper investment portfolio is the one that has a negative correlation. So the best option is for us to have a negative correlation. We don't care whether it is strong or weak. As long as we have gotten a negative correlation, then we can say it's good. Because also this one is basically looking at the movement. We are going to, if we have a negative correlation, it means these investment projects are also moving in an opposite direction. If you make a loss the other side, this side you are going to make a profit. So the negative one is better because it means these investment projects are moving in an opposite direction. If you get a positive correlation, then it means that these investment projects are actually moving in the same direction. If you make a loss in this investment, then even the other investment, you are also going to make a loss. So that's how we interpret the results that we have got from the different computations based on the method that we are going to use. I've told you we can use mean to variance, we can use correlation coefficient, we can use coefficient of variation, we can use convariance, we can also, based on the convariance, to make a decision. So next we are going to be looking at a simulation to help us understand, or we put what the different methods that we have been seeing. We are just going to look at question 2, November 2016. It's the one that will help us to go through the different formulas. But one thing to note is the fact that we will not be asked to do what we call the risks and return of a single asset. That was supposed to be for financial management on level 2. Level 3, it's portfolio analysis. In other words, you look at more than one investment project. And even if the examiner gives you let's say 3 investment projects. We don't have a formula as per your syllabus for computing the risk, because the problem is just on the risk of a portfolio for a project that has 3 investment assets. That's why we are restricting ourselves to only 2. If the examiner gives you more than 2 investment assets, then the interpretation or the approach is for you to make different, like you form your own investment portfolios. If they give you 3, then you make pairs so that they become 2, and you compute each of those portfolios to determine which one the business can undertake. Hello viewers, welcome back to our YouTube channel, KC Accountants Education Center. As we had looked at in the previous video, we had discussed things to do with portfolio theory, the introductory part of it, and we want to go into a practical computation where we want to look at a simulation, and it's going to be question 2, November 2016. That's where we are going to pick our simulation that we are going to look at. So without wasting more time, let's dive in and we look at the question, we read it through, and we see what we can do. So that's our question 2. Question 2, November 2016. So it says Diva Partners Limited, DPL, is an investment club of young Ugandan professionals currently investing in 5 different ventures in the East African region. The club's key objective this year is to further diversify our investment during the year. In other words, the objective is to diversify, to have very many investment projects. They are continuing to say that 2 investment opportunities available are summarized in the table below based on possible or the possibility of growth rates of the Ugandan economy. In other words, they have given us the growth rates in terms of how they expect the economy of Uganda to be. They have given us a table. We have the column for growth rate, which has fast growth rate, stable, and then slow. Then they have also given us the probability. Probability of having a fast growth economy is 0.2, stable is 0.5, slow is 0.3. They have also given us the return. These are return of the 2. Remember, there are 2 investment possibilities or investment opportunities. So they have given us the first investment as investment A and then investment B. They have also given us the returns for investment A and then the returns for investment B throughout those growth rates. They are continuing to say that the club's treasurer has advised that they should invest 50% in each project in order to exploit the less than perfect correlation between the returns of the two projects. She adds that with our investment in 7 different projects or ventures, after adding these two, there is no doubt that we would have diversified our diversified our all the systematic and the unsystematic risks for good. We shall talk about the systematic and unsystematic risks, but just know these are just risks that are coming from the industry. Others are coming from the company's activities. Some are from the company itself, others are coming from the industry in which that company operates. So we shall understand what those are, the systematic and the unsystematic risks. So when we look at the required says prepare, part A says prepare computations of standard deviations, meaning they want us to compute the standard deviations because they have given us different aspects. They want standard deviations of the part A. They have given us returns of projects A and project B, 6 marks. Part B says proposed to project portfolio. In other words, this one we are going to look at a portfolio. You have to understand that we looked at the formulas to compute the standard deviation of a portfolio and those of a single asset. So the first one, this part A, is all about computation of standard deviations of a single asset. Then this one will compute the standard deviation for a portfolio. A portfolio has more than, it has 2 or more projects. But as we said, as far as this paper is concerned, we are basically looking at only 2 portfolios. We shall look at some computations where we have more than 2 portfolios and what we should do. Then part B, they says advise DPL on the preferred option between the one in part A Roman 2 and an investment. Of course, here they are talking about the portfolio because this is part A Roman 2, and an investment of 25 and 75% in A and B respectively. So they have given us, these are like the benchmarks. We are going to see how we can use this. This has been given 7 marks. Part C, they want us to evaluate the treasurer's statement regarding the diversification of risks, 6 marks. This one we may talk about it maybe a little bit later when we understand what are systematic and unsystematic risks, but it's a very nice topic for you to understand, because once you understand it, you'll be able to use it when we look at some other things to come, like the adjusted risk. We shall look at that. So basically that's what we have, and I want us to go into the computations and we see what we have got. So let's start with part A. I want to start with our part A, and this part A, we want to look at part A Roman 1. This is where we are computing. They want us to compute standard deviation of a single asset. Standard deviation of a single asset, and we said the standard deviation of a single asset, the formula was, let's assume asset A is square root of summation P into return A minus the mean of A. The whole of it is squared. So this square root here is taking the entire thing. So that's how we compute the standard deviation for a single asset, but we know that this item here, that is the mean or the expected return of asset A is equivalent to summation P into return A. That's how we compute. So we are going to make sure that they have given us the return of asset A. They have given us the probability of of those assets. Now we want to compute some of this, and we'll be able to make some computations of this. So we want to find all these values, and we'll be able to compute what they want us to do. Normally, when we are dealing with these things to do with the expected return, things to do with the standard deviation, we usually, or we always use a table. We draw a table to illustrate the solution of this. So we are going to have a table that is going to help us to solve the standard deviation and the expected return as well. So we shall start with asset. We shall start with asset A. Remember, these were two assets. We had two investment projects. We had asset A and asset B. So we are starting with the asset A. Asset A. Let's draw our table. Once we are done with asset A, we have found the standard deviation of asset A, then we shall go and find the standard deviation of asset B. So let's draw our table so we can show the growth rate. We put the probability. Now we put the return for asset A. Remember, these were given to us in percentages. If you look at the question, so we shall get this probability. It will be P times the return of A. That's how we get the expected return. Get the probability times the return of that asset. So once that is done, we shall get, because we are picking it from the formula, so we want now this one, return of A minus expected return of A. So we want to first deal with this, then we shall get P times this, then squared. So we are taking the return of asset A minus the expected return of asset A. Let's first deal with this. Then finally we shall take the probability, this probability here, we multiply by this. So it will be return A minus expected return of asset A. This one is squared. So we have the growth here. We have first, that is the first growth. We have stable. We have slow. Those are the ones that we have. Now, we fill in the values. For first, they told us the probability is 0.2, and then stable is 0.5. This one is 0.3. Sometimes they may not give you all the probabilities. You make sure, we know that the total probability is always equal to 1. Total probability, once this one is not given to you, but you have this and this, you just add this plus this, that will give you a 0.7. So since we know that the total probability is 1, it will be 1 minus 0.7, that will give you a 0.3. That will be the balancing probability for this area. So you take note of that. Sometimes they may not give you all the values. The returns, this one they gave us, they are in percentages. So this one they gave us 6.4. This one they gave us 10%. This one they gave us 1.8. No, sorry. the returns they gave us in the question, what they gave us in the question, this one was 32, this one was 20, and this one was 6. So now we want to get this 0.3 times 6. It will give you, remember this is a percentage, so even this answer will also be in a percentage. So once you multiply 0.3 times the 6, it will give you a 1.8. This is a percentage, 1.8%. 0.5 times 20 is going to give you 10%. 0.2 times 32, it's going to give you 6.4. So we are now this is where we get our expected return. And expected return is the mean. We said expected return is summation. We get it as summation P into R. This is return of asset A times the probability. Once you sum them up, it will give you the total here. So we need the totals here. You can call them totals, or you can just use summation P of return R is equaling to, this one is going to give you 18.2. Remember, these are percentages, 18.2 as the total value. So also now go ahead and put in return A, which is this one, minus this is R bar, which represents the expected return or the mean. And this is the mean we have computed here as 18.2. So what we are going to do, we are going to have this, which is the return here. It will be 32 minus 18.2. Remember, all these are percentages. So 32 minus 18.2, that is going to give you 13.8. But all these are percentages. 13.8. When you get 20 minus the 18, it's going to give you 20 minus 18.2 is going to give you a 1.8. It's a positive 1.8. This one is 6 minus the 18.2. It's going to give you a negative 12.2. But all these are percentages. So what we are going to do is we are going to get the probability, this times this. First of all, we first get this squared. For this one, we first get this one squared times 0.2. So what we are going to do for this first one, it's going to be 13.8 squared. Once you have gotten that, then you multiply by 0.2, which is the probability here. So when you do that, you will see that 13.8 squared times 0.2 is going to give you 38.1. 0.10. We maintain the two decimal places this side. Then we also get 1.8 squared times 0.5. 1.8 squared times the 0.5. That is going to give you 1.62. Then we go to negative 12.2 squared times 0.3. That is going to give you 44.65. All these are percentages. So once you are done with that, then we are going to get the total. Because we said from the formula, we said that this part here, this is the formula for computing the standard deviation. But we know that this part here inside, this part inside here is the percentage for variance. In other words, we don't have a general formula for computing standard deviation, but we just take variance, we get the square root of variance. In other words, if you have standard deviation you just get standard deviation squared to give you the variance. But now if you want variance, you must take, if the variance will be standard deviation squared. So if you want to get the standard deviation, it means this one you just take the square root, meaning this portion you are seeing inside here is what we call the variance. So we are just going to get the total variance in here. When we sum up this is going to give you the variance of asset A. And the variance is going to be 84.37. 84.37. But remember, all these are percentages. So this is the summation, the whole summation of this one. So now if they want us to compute the standard deviation, we shall just get the square root of this 84.37. So we just come here and say standard deviation of A will be the square root of variance. And our variance was 84.37. So the square root of that is going to give you 9.185. You can keep it to 3 decimal places. But remember, all this is in percentage. The other person can just call it 9.2%. That is the standard deviation for asset A. Then we go and compute the standard deviation for asset B, because we had two assets. So for asset B, we are also going to have the same table. We have the growth, we have the probability. I'm just going to use letter P to show the probability. We have the return of asset B. They are all in percentages. Then we are going to get the probability times the return of asset B to give us the expected return, or what we call the mean. Then we get asset return of B minus the mean, or the expected return of asset B, which is RB bar. Then once we are done with that, we can have the probability times this return of asset B minus expected return of asset B, but the whole of it is squared. This is going to help us to compute the variance. So we start with the first, then we have the stable, then we have the slow. These are the states of nature. So here they gave us, they are the same probabilities we use, 0.2, 0.5, then 0.3. Then with a return for asset B, they gave us 12. For stable, it is 15. This is 21. The implication here is that if the economy is at a steady growth, this investment will yield a 12%. That is the return. If it is at the stable state, it will give us 15%. If it is at a slow state, then it will give us 20%. That is the implication. So we just now compute as we did. We just get the probability times the return of asset B. So it will be 0.2 times 12. That will give you 2.4. Then 0.5 times 15 is going to give you 7.5. 0.3 times 21 is going to give you 6.3. Once you add all these, you add the 2.4 plus 7.45 plus 6.3, it's going to give you 16.2. This is your return of asset B with the bar. Then we get this, we get the return. This is our return minus this 16. So it will be 12 minus 16.2. That is going to give you a negative 4.2. All these are in percentages. Then we get 15 minus 16.2 is going to give you negative 1.2. Then 21 minus 16.2, that is going to give you a 4.8 positive. Then once what we are going to do, we are going to square this. You get this, you square negative 4.2, then you multiply by the probability of 0.2. So the first one we shall just get squared times 0.2, and that will give you a 3.53. You can make it to 3 decimal places if you want. Then negative 1.2 squared times 0.5, that is going to give you a 0.72. All these are percentages. 4.8 squared times 0.3, that is going to give you 6.912. So this will give you the variance of asset B, and that is going to be the total. If you sum all these, you are going to get 11.16%. So we go ahead and now compute the standard deviation. Standard deviation of asset B is the square root of variance, and our variance was 11.6. So this is going to give you 3.341%. That is the standard deviation. So that's how we compute the standard deviation. So we now want to look at part B. Our part 2, this is this is part A, Roman 2. Part A, Roman 2. In this one, they wanted us to compute the standard deviation for the proposed 2 projects. In other words, this is the proposed 2 project portfolio, and these 2 project portfolio, they are the combination, because they never told us the percentage, so we assume the portions are 50-50, the composition. So we take the composition to be 50%. Composition to be 50%. Those are the weights that we are going to use when this 50%. So they wanted us to compute the standard deviation, but we know that the standard deviation, the formula for computing standard deviation of a portfolio, we discussed that. Standard deviation of a portfolio, let me just use P to show that we are meaning a portfolio. It's a very big formula. This is weight A, this is weight of asset A squared, the standard deviation of asset A squared, plus the weight of asset B, the weight of asset B squared, times the standard deviation squared of asset B, plus 2 standard deviation. We know standard deviation is the measure of risk of asset A times standard deviation of asset B. This times, so also times weight of asset A times weight of asset B. Then we have the coefficient, correlation coefficient. This is lambda AB. This one is the one that represents the correlation coefficient. So when you look at this formula, the only thing that we haven't computed is this thing, the correlation coefficient, or lambda A and B. So we need to first compute this correlation coefficient before we substitute that into our formula. So we need to first compute this so-called correlation coefficient. So this lambda A B is the same as the correlation coefficient. And that correlation coefficient is given by a formula convariance, let me just use conv, into A, the convariance of A and B divided by standard deviation of asset A times standard deviation of asset B. That's how we compute the correlation coefficient. But we will see now we've introduced in something new, which is the convariance. The convariance, we need also to understand how do we compute the convariance. This part up here, this one, the convariance of A and B. But the convariance, or what I have abbreviated as conv of A and B, is equivalent to summation P, that is probability, into risk A minus risk B. That is the expected risk A. This is the expected, it is risk A. It is the expected return of asset A into R, return A minus the expected return of, this is return B minus the expected return of asset B. That's how we compute. So we need to know all these items, so that, because we need to first compute the convariance, then once we are done with the convariance, we substitute into the correlation coefficient. After getting the correlation coefficient, then we can be able to substitute that into our standard deviation formula for a portfolio to be able to get the standard deviation for a portfolio. So we can also use, we are going to use a graph to illustrate this. We start with the growth, we put the probability, let me just call it P. Then we have return A, we are first computing this. Return A minus return B, return, expected return of asset A. Then this is return of asset B minus the expected return of asset B. Then finally we shall get the combination of this and this times the probability. So we shall just get the whole of this up here. Probability P into return A minus expected return of asset B, then return A, return of asset B minus the expected return of asset B. So you have seen that in all of this formula that you are seeing here, the whole of this we have already computed the things that we need. The only thing that we don't have is only this. So that's what we are trying to look at. So we are going to pick the information. Remember, this question was continuous. So we are going to pick the information that we had computed earlier, because this is the portfolio is for that asset A and asset B. We had already computed the return of asset A, the expected return of asset A and B. And we had already also computed the standard deviation for each of those two assets. So we are just going to remove those. We are just going to pick those items from the working that we did. So the probability, these ones, they don't change. Here we have first, stable, then finally we have slow. The probability is 0.2 for first, stable is 0.5, and here is 0.3. Then, of course, this one we had already computed it, the 13.8. All of them are in percentages. 13.8, this is 1.8, and lastly is negative 12.2. Even this one I had already computed, it's negative 4.2, this is negative 1.2, and finally we have a 4.8 positive. So we are going now to multiply. We multiply through, we are going to get the probability times this times this. So when you get 0.2 times 13.8, 8 times negative 4.2. Or you can first multiply this and this, then you multiply by this, but it's the same thing. So this is going to give you negative 11.59. This one, if you get 0.5 times 1.1 times negative 1.1, it's going to give you negative 1.08. Then lastly, this 0.3 times negative 12.2 times 4.8 is going to give you negative 17.57. So we add up this side. We need the total here. The total here is giving us a negative 30. Negative 30.24. All these are percentages. But remember we said our convariance. If you look at the convariance, this is the formula for convariance, which is the whole of this is what we are seeing in this column. So the total we have gotten here, this is the convariance of 30.24. That is the convariance. It's a negative 30.24%. The good thing is that they never told us to advise basing on the convariance. Otherwise, if they had told us to make a decision on this portfolio, then you would accept the portfolio. Remember we said for convariance, when you are basically looking at convariance, we said convariance, we should accept the proposal if at all, we should accept the proposal of the investment if at all the convariance is negative. And the negative convariance means that these two assets are moving in an opposite direction. Moving in an opposite direction means that if this asset makes a profit, the other one makes a loss. And if the other one makes a loss, this one makes a profit. That is the opposite direction. That movement that we are talking about. Not having assets, because if the convariance is positive, it means the two assets are moving in the same direction. The implication is that if one asset makes a loss, even the other one has to make a loss. So we only accept investment if at all the convariance is negative. So now let's finalize with computing our correlation coefficient, because we have gotten the convariance that we wanted. So correlation coefficient, we said it is the convariance of asset A and B into the standard deviation of A times the standard deviation of asset B. These are single assets. So this is going to be negative 30.24. Remember, all these are percentages over, we also take the percentage, the standard deviations that we computed in the first part. For asset A it was 9.185, then times the one for the standard deviation for asset B was 3.34. So once you sort all this, you will get a negative 0.98573. You can round it off to a negative 0.99%. All these are percentages. So that's the convariance. This is the convariance. So once we have gotten our convariance as negative 0.99, we can substitute into our formula for standard deviation of a portfolio. Remember we said the standard deviation is the measure of risk. So here we are basically computing the risk of that portfolio. So let's substitute in our, we are looking for the standard deviation of a portfolio. So we put in that formula that this is 0.5 squared times, that is the weight. Weight is 50%. Remember we said they never gave us the weights. So we assumed that each asset was 50%, 50%, because there were only two assets. So you get 100 divided by 2. If there were 3 assets, then it means you are going to be dividing by 3. If at all they have never told you the proportions. but not forgetting that when you're handling portfolio as per this paper, as per the syllabus of this paper, we only stop on 2 investments. If the examiner gives you more investment portfolios, then we are going to see how we handle those. So we also take now the standard deviation of asset A, which was 9.1, of course 885 squared, plus the 0.5. This is now the weight of asset B, 0.5 or 50% squared, times the standard deviation for that, which is 3.34, plus now we take the 2 times, I'm going to make this to form that into a bracket. So the whole of it is going to be multiplying all this that I'm writing here. 185 times the 3.34 times 0.5 times 0.5. These are weights. Times now this negative, I'm just going to put it in the bracket. 0.99. All of it. It's only this with those opening brackets. So once you sort that with a calculator, you'll get a 2.975%. All these are in percentages. You can round it off to 3%. So that's how you compute the standard deviation of a portfolio. Now, part C, this is part B. Remember, the other one was part A, but it had two Roman numerals, 1 and 2. So part B, they want us to compute we are looking at a new portfolio. This is a new portfolio, and its composition. They gave us 25% and 75%. Of course, sometimes they may give you 1%. If they give you 25% or 20%, you just get 100 minus that percentage to get the remaining percentage for the other asset. Meaning this 25% was for asset A. Asset A, the 75% was for asset B. So the examiner wants us to choose between this other investment that we computed previously. We choose between the other investment that we computed and this investment, this new investment. The only difference with this new investment is that the composition changes. The other one was 50-50. This one is 25-75. That is the only thing that is changing. So since these weights are changing, it means we have to compute a new standard deviation for this new portfolio whose weights are changing. So the only thing that is changing with this new investment is only the weights, and the rest are the same. So we are going to use the same information that we have computed previously. We make sure that we put in these new weights and we compute the standard deviation. So we use the same formula. Standard deviation of a portfolio. This is a new portfolio whose composition is 25% and 75%. So the weights, we start with the weights 0.25 for asset A squared times the 9.18. This is the standard deviation that we computed, plus the 0.75 squared times the 3.34 squared. That is the risk, the standard deviation for asset B that we had computed earlier alone. Then minus, we put all this in the bracket. It is 2 times 0.25 times the 0.75 times the 9.185 times the 3.34. I've taken, because this one is supposed to be a plus, but I have eliminated it with a minus. This minus is coming from the convariance. Remember, our convariance has a negative. So here I'm just going to put times 30.24, close the bracket. So once you do that, you compute, you'll find that the standard deviation of a new investment is going to be 3.3634%. Can take it as 3.4. So we have now so far established the standard deviation for that new portfolio. But they asked us to choose between the two portfolios. The portfolio that we computed with the standard deviation that we saw as 2.975, which we rounded off to 3%. With this new investment, the only thing that changed in this new investment is because we are introducing in something to do with the weights. Now, you should have realized so far that we have risks, and we said the risks are the ones that are measured using standard deviation. So we only have the standard deviation. We have a standard deviation for this new investment and also a standard deviation for the other old portfolio. Remember, in the second computation, we only computed the standard deviation of that portfolio. That's the only thing that we computed. And also we also computed the standard deviation for the new portfolio. So we only have standard deviation. And we know that you can't choose using risks. You can't base on risks to just choose which investment to go with. We don't say like that, because we basically look at the risks and the returns at the same time. So we can't just base on the standard deviation and we make a conclusion. And the examiner said, because the examiner simply said, advise on the preferred option between the one that we computed in as part A, Roman 2, and this new investment, the new portfolio. And I remember I told you, when you are choosing which investment portfolio to take up, we said you can use a mean to variance relationship. You can choose based on the mean to variance relationship, or you can use the correlation coefficient. You can use the correlation coefficient, or you can use the coefficient of variation. Coefficient of variation. Remember, this coefficient of variation and this one, they were mainly used in a single asset. But now we have something that we discussed earlier, that if you want to use mean to variance relationship, when the examiner, you only do that when the examiner has told you to do so. In other words, we choose using that when the examiner has told us to use mean to variance relationship. And the reason we said this is a weak analysis, so we use it only and only when the examiner has told us to use it. Therefore, for you to use these other ones, the correlation coefficient, then the coefficient of valuation, those are the best. You can either use, you don't use two, of course you pick one. You can either use the correlation coefficient or the coefficient of variation. in order to choose which portfolio to undertake. And to be specific, I say the mean to variance relationship and the coefficient of variation, most of the times they are used when you are deciding those single assets. But since we are dealing with a portfolio, you can use, it can also be used, but the one that is most preferred is the correlation coefficient. But you can also use a coefficient of variation. So when we use this correlation coefficient, when you use this correlation coefficient of variation, let me start with that. We said it's on, if you try to look at its formula, we just get the risk, then we divide it by the expected return. In other words, we just get risk, which is the standard deviation, divided by the expected return, which is the mean. So you can see that in both scenarios we have risks, but we are looking for the expected return. Because you see, once you are going to use the coefficient of variation, the formula is going to be the risk over the expected return, or which we call the standard deviation over mean. But now we already computed in our portfolios, the two portfolios, we have already computed the risk, but we don't have the expected return. So we need now to compute the expected return of a portfolio, not of a single asset. So what we are going to compute is the expected return of a portfolio. Because we said we can't base on risk alone to make a decision. Now, the formula for computing the expected return, we are going to first start with that asset that has a 50-50 composition. Expected return for portfolio 1, the one that has a 50-50. The formula is weight of asset A times the expected return of asset A, that is for a single asset, plus weight of asset B times the expected return of that asset B. So we know all these. We have 0.5, that's the weight, this 50, times the 18.2, that is the expected return that we computed earlier for asset A, plus 0.5 times the expected return that we computed for asset B was 16.2 in the first tables we drew. And this is going to give you a 17.2%. It gives you a 17.2%. So we compute the expected return for the new portfolio with this when these weights are different. So we go to the expected return of a portfolio 2, where the expected return, the composition is 25-75. The same, we use weight of asset A times the expected return of asset A plus weight of asset B times the expected return of asset B. So the weight is 0.25 times 18.2 plus the 0.75 times the expected return of 16.2. Once you do that, you will get a 16.2%. Now, we want to go to where we make a decision, because we are going to make a decision using the coefficient of variation. So we can just illustrate this in a table. Can have maybe the details, can have the risk, you can have the expected return. Let me use ER. Then the correlation, the coefficient of variation. Let me just call it CV. So for portfolio A, this is portfolio 1, then the second portfolio. First portfolio had a risk of 2.975. This one had 3.3634. All these are percentages. This one has 17.2. This one has 16.2. Then when we are getting, of course, when we are getting, we said correlation coefficient is just the risk, which is 2.975 divided by the 17.2. All these are percentages. And this one is going to give you 0.17. We do the same. This is 3, which is the risk, 3.3634 divided by the 16.2. And this is going to give you 0.2. Now we come now to the comment. How do we comment? Or how do we advise? When using the correlation coefficient, we said that the lower the risk, the better. So we will choose the portfolio that has the lowest correlation, the lowest coefficient of variation. So the best investment portfolio will be the first one, because it is the one that has the lowest. This one is 0.2, this one is 0.17. So this one has the lower. We shall go with portfolio 1, which is the first one that had 50-50 composition. So for the coefficient of valuation, we take the project 1 because it is the one that has the lowest correlation coefficient. We said you don't use 2. You just pick one formula and you will be done. So that's how we are going to be advising. So we go with portfolio 1. Portfolio 1. That's how we should advise. So the other part for the theory, we are going to talk about it when we have understood the systematic and the unsystematic risks, and we are going to discuss that when we go to CAPAM, when you're using CAPAM. That's where we are going to talk about those kind of risks and we understand them theoretically, what they mean and how we can basically interpret them. Now I want us to remind ourselves what we have so far covered as far as portfolio theory is concerned. So let's look at a recap. We'll try to recap what we have discussed and we see how we can move. Recap on portfolio theory. So we have said that when we are looking at a portfolio, we need to understand two things. We need to understand that if we are looking at a portfolio, you need to understand whether you are dealing with a single asset or a multiple asset or multiple assets. So that's one starting point. And the reason as why I'm trying to emphasize more on this is because we are going to introduce CAPAM, capital asset pricing model. That is the method that we left out for computing the cost of equity. And we really need to understand this because CAPAM is going to pick from here. So that's why I'm focusing much on it. So we agreed that once we are dealing with multiple assets, then we have what we call a portfolio. Once we are dealing with multiple assets or a portfolio, that's where we bring in that's where we need to put more emphasis as far as this syllabus is concerned, because for a single asset, that's basically what we did in our financial management on level 2. So for a multiple asset or a portfolio, This is where the syllabus is taking us. And as far as the syllabus is concerned, the syllabus limits us on only 2 investment portfolio or investment projects, on only 2 assets. So it is either we are going to have a portfolio or we are going to have a single asset in the question. That's as per the syllabus. The syllabus restricts us to only 2 investment projects, and I will explain why they limit us, especially when we are computing the risk, because we can't have a formula that will help us to compute the risk of a portfolio which has more than 2 assets. That's the only thing, but the rest would be fine if at all we had that formula. The other formula that we did, the longer one, it's for only 2 assets. We don't have a formula that we can use to compute a portfolio of more than 2 assets. But we are going to see how we can maneuver through when the examiner gives us multiple assets. Now, in both cases, you should be interested whether it is going to be a single asset or it's a multiple assets. You should be interested in how to deal with risks and returns. In both scenarios, risks and returns, you should be more interested in how you are going to deal with risks and returns. So when you are dealing with a single asset, when it is a single asset, how do we treat the risk and the return? We said we compute what we call the expected return, or what we call the R of that asset, or the mean of that asset. If it is asset A, if it is asset B, whichever asset it is. When you're dealing with it, you compute the expected return. And we said the expected return of asset, let's assume asset A, we said it is given by the formula summation P, that is the probability, times the return. This is the return of that asset. This is the probability for that state of nature that they may give you. The other thing that you need to look at is the risk. Still, when you're dealing with a single asset, you look at the risks. This is how we handle the returns, but now we are focusing on the risk. We said that risks are measured using standard deviation. But the formula, we say that we don't have a formula for computing standard deviation. So what we do, we just get the square root of variance. So we said that the standard deviation is actually the square root of variance. Since we don't have a specific formula for computing the standard deviation of that asset, whether asset A, whether asset X, whichever it is. And we know that variance, from our qualitative techniques, we know that variance is given by the formula summation P into, this is the return of asset A minus the expected return of asset A squared. So this means if you want to get the standard deviation of asset A, it will be this summation P into return of asset A minus expected return of asset A squared under square root. So that's how we compute the standard deviation if at all you are dealing with a single asset. Now, once it comes to a portfolio, and we said as per the syllabus, it is limiting us on only 2 assets. If you are making an investment, it's either maybe you're building a school and maybe you're running a restaurant. So you choose only 2 projects. So this is where you are dealing with multiple assets. Now, for a portfolio, the focus is, as I said, is on 2 assets. So the focus is still the same because we said in either way we have to focus on the risks and returns. So we need to compute the expected return of a portfolio of those 2 assets. And we said the formula for computing that is given by this one. We can abbreviate it as RP1 with a bar. So this one is, we get the weight of asset A times the expected return of asset A plus the weight of asset B times the expected return of asset B. That's how we get the expected return of a portfolio. Now, for us to compute the risk or the risks in a portfolio, we use the other big formula that we looked at, standard deviation of a portfolio. We took this bigger formula where we said W, this is weight of asset A squared times the standard deviation of asset A squared plus the weight of asset B squared times the standard deviation of asset B squared plus 2 times weight of asset A times weight of asset B times standard deviation of asset A times standard deviation of asset B, then times the correlation coefficient of asset A and B. That is lambda A and B. This lambda is a mathematical thing. But we said that for us to be able to compute this lambda or the correlation coefficient of asset A and B, that is the correlation coefficient between asset A and B. That this one we said it is given by the formula convariance, the convariance of A and B, of asset A and asset B, divided by the standard deviation of asset A times the standard deviation of asset B. But we also need to understand that the convariance, you can call it convariance, conv, of asset B is given by the summation P into the return of asset A minus the expected return of asset A times the return of asset B minus the expected return of asset B. That's the formula. And for you to be able to do that, you need to understand what the examiner wants you to do. Either to advise, you need to also understand how you can be able to advise based on whichever formula the examiner has told you to use. So we have learned how to use each of these formulas. We have realized that we have to use a table because the table has its own ingredients, or it has its own things, items that we have to include and be able to compute. But the main point to know is how to make a decision and the available tools we can use to help us make a decision. That is very important for us, maybe to remind ourselves on the decision taking, the decision making or the decision taking, because you are not going to be making a decision, but you are going to be advising. You are going to be advising, or how do we comment on the results that we have got. We say that we use the following tools as we discussed about them when we are making a decision. We said we can use the mean to variance analysis, variance relationship. we can use part B, we can use the correlation coefficient. Let's start with the coefficient of variation. Coefficient of variation. Part C, we can use the correlation coefficient. And lastly, we can use the covariance. Those are the tools that we can use. These two, they are more related. They are more used in a portfolio. And these two, they are more used in a single asset. Single asset. This is multiple. I'm not saying these other ones can't be used in a portfolio. No, we can use them. Now, I want you to listen very well to the argument I'm going to make upon these decision-making tools, because it is very important and it is going to help you a lot. So, we said that you will use this one, mean to variance relationship, or the coefficient of variation when you are dealing with a single asset. So you will be having asset A, asset B, and you want to select which asset you should choose. That's what we call a single asset. A single investment proposal, if let's say you have building a hospital, constructing a school, maybe starting a business, then you have those items, but you want to pick only one. So you can use mean to variance relationship or the coefficient of variation. But it's very rare for the examiner to bring a question that is focusing on a single asset, especially on level 3 in advanced financial management. That one can come in the financial management of level 2. So that calls us to understanding the portfolio, because the other single asset is not a portfolio. So I also said, or I also commented that we can use these two when we are making a portfolio or when we are taking a decision on a portfolio. We can use them. But we said if we are to use the mean to variance relationship, then we pick the higher. We pick the investment that has the highest risk. Because the assumption is that the higher the risk, the higher the return. That is the assumption for the mean to variance relationship. The higher the risk, the higher the returns. And once you are dealing with a single asset, you are now going to begin to trace out which investment that has a highest risk. But even when it's a portfolio, let's say you have 2 investment projects and you want to make a decision using mean to variance relationship. Let's say you have asset A and asset B, and then you want to choose which portfolio that has the highest risk. So we are going to choose that portfolio that has a higher risk, and it will be the one that will advise the business to take on. So you have to be very careful that for the mean to variance relationship, we take the investment that has the highest risks, because the assumption is that the more risky the business is, the more returns they are expected. That's the assumption. Now, once we move to the correlation, the coefficient of variation. For coefficient of variation, we said it's risk or the standard deviation. We get standard deviation divided by the expected returns. So we said here, the lower the coefficient of variation, the better the investment, or the better the investment idea. So we will take up the investment, or we will take up the asset that has the lowest correlation coefficient, because we are getting the risk divided by expected return. We get the risk and we put it against the expected return. So we take the one that has the lower value. So you choose, so you can also use, as I said, you can also use these two methods when we are dealing with a portfolio. But it's only, most of the times, it's only when the examiner has told you to do so, because it's not all that preferred. It is a weak, it's a weak tool. So you only use that when the examiner has requested you to use it or to use them, especially the mean to variance relationship. And even for a single asset, this mean to variance relationship is also weak unless the examiner has told you to use it. But if the examiner doesn't specify that you use mean to variance relationship, even if you are dealing with a single asset, please go ahead and compute the coefficient of variation, because that one, it gives you more realistic approach. Now, the two that are remaining, the coefficient, the correlation coefficient, then the convariance. These are the two tools. They are the ones that we use for making a decision in a portfolio, the correlation coefficient and then the convariance. Though we can't keep on using all of them, we can't say we are going to use this and the other at the same time. We pick one. But now, I want to comment that the popular tool that we use is actually the correlation coefficient. If at all we are dealing with a portfolio, that is the popular tool. Even though this convariance is actually within the coefficient, because we've seen when you're computing the correlation coefficient, there is no way you're going to compute it minus computing the convariance. By the time you reach to the correlation coefficient, you have already known what decision to take, because the convariance will either be a negative or a positive. And we said if it is a negative, you take up the investment. Reason, it's because the investment ideas are moving in an opposite direction. So, as you can see, all these two methods, all these two tools, they are telling you where you should invest your money depending on how the two investments move. Is this going to move in a positive way, or is it going to move in a negative way? Because, as I said, if the convariance is negative, it means the assets are moving in an opposite direction, where if one makes a loss, then it's anticipated that the other will make a profit. But the problem with the convariance, it doesn't tell to what level is the loss, because it only tells you that it's going to be a positive or it's going to be a negative. But it doesn't tell you to what extent. If I'm making a loss, like, it doesn't give you the level of the loss that you are going to make. And that makes the correlation coefficient unique, because it gives you the level. You will have either a negative or a positive, but at the same time, it will also give you a level. So the popular tool you will use is the correlation coefficient, because when you are using the correlation coefficient, the answer is expected to be between -1 to +1. It's either going to be a negative or it's going to be a positive. In other words, it's more of like the probability. That's how the answer should actually look like. Less than or equal to -1, less than or equal to +1. meaning when it's a positive correlation, then we shall have some ranges. Of course, you know, we have some ranges. It can be between, because you are supposed to start from 0 then to -1, then 0 to a +1. So we can have here a 0.5, even here 0.5. This one is a negative. So it can be between 0 to negative 0.5, or it can be between negative 0.5 to 1. So it gives you a range, and you know that is it going to be a positive, negative, a strong positive correlation, or a weak positive correlation, or a strong negative correlation, or a weak negative correlation. Because we know if it is ranging from 0 to negative 0.5, then it's going to be a weak negative correlation. If it is between 0 to 0.5, a positive, then it's going to be a weak positive correlation. If it is moving from 0.5 to 1, then it's going to be a strong positive correlation. So that's what we are meaning, that it gives you a level. It tells you that if you are in this kind of scenario, or the answer you have gotten is maybe in this range, it's weak or it's strong, either positive or negative. So you will use the convariance, the correlation coefficient, if you want to make a decision on a portfolio. That's the best preferred method. But if the examiner tells you to use the convariance, go ahead. Just look at the situation whether you have gotten a positive or you have gotten a negative. But I've told you the weakness of the correlation coefficient of the convariance is the fact that it doesn't give you a range, or it doesn't give you the extent to which a loss or a profit is going to be for the given computation that you have done. Remember, we are more like appraising investments. We are looking at how the assets are going to perform in terms of the risks and the returns. We try to organize to advise the company whether to take up the projects or not to take up the projects. So don't forget that we say that in the process of computing the correlation coefficient, the convariance comes in. But the popular tool for us to use for the other one that computes the one that computes for a single asset, we should go with the correlation, the coefficient of variation. That is for a single asset. Then for a portfolio, we should go with the correlation coefficient. So I want us to look at a simulation, and we are going to pick this question from, let's use August 2018. Question 4 part A. Question 4 part A. So let's look at the question, we read through it, and we see how we can be able to advise based on the tools that we shall find there. Simulation 2, it's from August 2018, question 4 part A. So let's look at the required and we see what we have to do. So that's our question 4. That's our question 4, and the required, they want us to, part A wants us to evaluate. It says evaluate the two alternative investments and advise the group of young graduates. So when the examiner says evaluate, it means you calculate and then give a comment or you give an advice. So we need to calculate and at the same time we advise the group of younger graduates. So when you look at the question, let's try to look at the question. We'll read through the question. Let me try to zoom in a little bit. So when you read through the question, you can see it says a group of young graduates have formed an investment club and they have just acquired a loan from the Youth Venture Capital Fund under the Ministry of Gender, Labor and Social Development. They are considering two projects. Project A, they are considering two projects. A car washing bay, that is project W, and a poultry farming, project P. The returns from the two projects vary depending on the state of economic growth. They are as follows. They have given us the state of economy: rapid, stable, and slow. They have given us the probability. They have given us the returns in percentage from project A and project T, from project W and project P. They are continuing to say that since there appears to be a degree of inverse correlation between demand and therefore net cash flow from the two projects, it seems sensible to consider diversification. Remember, we are only taking part A, and part A wants us to evaluate the two alternative investments and advise the group of younger graduates. Part B, if you look at part B, it says discuss the limitations of portfolio analysis, 10 marks. That's like giving you something for free. Just want you to pass. Limitations of portfolio theory, whichever item you can think of. One of them is what we had already looked at. We said the syllabus only limits us to only 2 investment proposals. So what if someone wants to diversify, like invest in more than 10 investment ideas? Because that's what happens in the real life. That's one limitation, that we don't have the formulas of computing the risk of a portfolio that exceeds more than 2 investment projects. So it's a 1 point out of the 10. So once you look at the question, there are 2 investment alternatives. That's project W and project P. Here we are not going to look at the 2. We are not going to look at these 2 as a single item, but we have to do both of them at once. Like, we are not going to specify that we look at project this and project that. We are just going to do them at once. Since the 2 projects of a car washing bay and a poultry farm are moving together, so they are going to invest in those 2 items. It's not that they want you to help them understand which one to choose, but they are already doing those 2, or they have already selected the 2 investment projects that they are going to invest their money into for the loan that they have acquired. So we are taking the question is whether it would be viable for them to invest in those 2 investment projects, but it's not to make them decide which one to take. I hope you are getting what we are trying to do. So for a portfolio, we take it at once, we compute it at once, and we advise at once whether they should invest or they shouldn't. So the question is, which of the decision-taking tools are we going to use to make a decision or to help them understand whether it will be viable for them. And since the examiner remained silent, then we are going to do correlation coefficient, because it will include the convariance. Remember, within the formula for computing the correlation coefficient, we have something to do with the convariance. So it's better we take the correlation coefficient because it combines the convariance. It gives you the extent to which whether a negative or a positive has been, and you can be able to know. So we are trying to know how we can approach these questions. So here we've agreed that we are going to take the correlation coefficient because it will help us to understand the extent when we are evaluating this portfolio. So for us to know that, we better do correlation coefficient. So here we need to find the correlation coefficient between project W and project P. Then we can comment, because the examiner wants us to evaluate and then advise on whether to proceed with the investment. So when we are using correlation coefficient, it doesn't matter whether it's a strong or it's a weak, but we just need to know the results. Whether the results are negative. If they are negative, then we should recommend. If the investment are going to be, if the coefficient or the result is going to be positive, then we should tell them not to invest the money in there. So the differences between a multiple asset and then a single asset is that for a single asset, they can give you a number of assets, then they tell you to pick one. But for a portfolio, they have already given you, the people that are going to make the investment, or the company has already done the choice of those two investment projects, but they just want you to help them understand whether it's going to make money if they go ahead and invest in it. I want you to understand that. Otherwise, if you don't pick it, it's going to be a little bit hard for you to be able to draw the conclusion or to write the comment. So let's go ahead and look at what we have to do. So the solution, we actually want to do correlation coefficient. It's lambda A or B. No, it's not going to be A or B because they gave us the exact letters. Let's use the letters they gave us. It is W, and P. It's going to be the convariance of W and P over the standard deviation of W times the standard deviation of P. So we know, we can state all the formulas at once. We know that the standard deviation of W will actually be the square root of variance, summation P into R. This is the return of W minus the expected return of W squared. And also our convariance of asset W and P is going to be given by summation P into RW minus RW bar into bracket RWP minus the RP bar. So those are the formulas that we need. So we need to identify some of the things. We need now to get the standard deviation of project W and project P. We also need to get the return of W and then the return of project P. Once we have gotten all those, then we will be able to substitute into the formula for convariance, and we'll be able to get the correlation coefficient. So that's basically what we are going to do. So let's start with the project for project W. What are we looking at in the project W? We are looking at, one, We are looking at the expected return, and at the same time we want the standard deviation. So we start with the state, that is the state of nature or the state of the economy. Then probability, then we put the return of W. All these are in percentages. Let me just put here percentages. Then we compute now the expected return, which is the P times the return W. Then we can also do it at once, because we also want to compute the standard deviation. We put it in one table. So we put LW minus the RW bar. Then we also put the probability into RW minus RW bar squared. So we do it at once. So that's how you do it to make sure that at least you save time. State of nature, we have a rapid state, we have a stable one, and we have a slow. So the probability they gave us 0.15. This is 0.7. Of course, the last one should be 0.15. The return of W, first one they gave us 45. This is 20. This is negative 10. Then we multiply this one 0.1. 0.15. It's going to be this times this. 0.15 times 45. It's going to give you 6.75. 6.75. Then 0.7 times 20 is giving you 14. Then 0.15 times negative 10, it will give you a negative 1.5. Once you get the total, this is now the return of W with the bar here. This is giving us, once you add this plus this plus this, it is going to give you 19.25. Then we do this. It is this minus this. 45 minus 19.25 is giving you 25.75. Then 14 minus 19.25, no, it is 20. 20 minus 19.25, it is giving you 0.75. Then negative 10 minus, it is negative 10 minus 19.25. It's going to give you 29.25. So we multiply this by the probability. We get whatever in this row, we multiply by the probability here. So this times this is going to give you 99.4594. You can write any decimal places you want. Then 0.7 times 0.75. It's going to give you 0.3938. Then 0.15 times negative. Remember, these are going to be squared. We first square these ones. You get 25.75 squared times this, because there is these ones are squared. This is going to give you 128.3344. Once you add those two, you will get your variance of 228.18. That is the variance. Then now you can go ahead and compute. Of course, we have already gotten our return, expected return as 19.25. Then we compute the standard deviation of W is the square root of 228.18, and this is giving you 15.1%. All of them are in percentages. Then you go to, for project P, we also do the same. We draw a table. We start with the state, we put the probability, we put the return of P, then expected return, then we put RP minus the RP bar, Then we also look at now computing the into RP minus RP bar, but the whole of it is squared. So we put in the state, you have the rapid, you have the stable, then slow. Same probabilities, 1 point. Then the returns here, they gave us 18, this one is 17, this one is 16. So multiply this times this, it's giving you 2.7, this one is 11.9, and this one is 2.4. So once you add, you'll get the RP bar, which is, it is giving us a 17.0. So we go into this, it's going to be this minus this. So it is 18 minus 17, that is giving you a 1. 17 minus 17, that is giving you a 0. 16 minus 17, that is a negative 1. So we get the squared. You square this, you multiply by the probability. 1 squared, that is a 1 times the 0.01, the 0.15, it is going to give you 0.15. This one is a 0. This one is going to give you also 0.15. Once you sum that, it's going to give you a 0.3 as your variance. Now, once you have the variance, then you go ahead and compute. We have already established our expected return as 17.0%. Then the standard deviation. Standard deviation is the root of variance. Variance was 0.3. So this is giving you 0.55. Now we first compute the convariance because we need coefficient of variation. We first start with the convariance of W and P. Remember, they are going to be in summation W minus RW bar into RP minus RP bar. So that's what we want. So we need this. We need this. So we need to draw a table that is going to help us generate that. So we draw a table. It's also going to have the state. That is the state of the economy. We have now the probability. If you had the space, you would have included it the other side. But it's better you do it separately because we have already computed this. These are the only two that we needed. Then the last one is going to be where we are multiplying everything into RW minus RW bar, then into RP minus RP bar. All of these are percentages. So we start with the rapid, stable, then slow. Same probability. This is 0.7. This is 0.15. These ones we pick them from our asset A, our asset W. This was 25.75. This is 0.75. This is negative 29.25. Then we also pick this one from asset P. This was 101. This was negative 1. Then we multiply. Of course, we are multiplying the first one. We first multiply this times this. Then the answer we get, we multiply by this. So we are getting this times this times this. Because this is multiplication, has no problem. This one is a 0 because 0 times it will be a 0 throughout. So this one is going to be 3.8625. Then the last one is 4.3875. Once you add that, you'll be able to get 8.25. This is your convariance. It is also in percentage. This is your convariance of WP. It's a positive figure. So now we have gotten the convariance. So we now look at the correlation coefficient. We said it is going to be the convariance over standard deviation of asset W times the standard deviation of asset P. So it is going to be the convariance. We have already gotten it as 8.25. So now we are seeing it is a positive. You know what to comment already. 0.1 times 0.548. So you will see that this is going to be 0.997, which is approximately 1. But most of the times you don't round off, because if you round off to 1 and you have other projects, maybe the other portfolio is 0.99, let's say 2. Once you round off, also this one will be 1. So you will end up not having what to comment. But you are seeing there is a difference. This is a 2, this is a 5, there is a difference of 0.05, which is a very big figure, since all these are just closing figures. So now we want to know, how do we comment? We want to comment or advise. We want to advise. We said we are basing on. Now we can see. We said we don't care whether it is which number or which number. We just look at the sign when you are making the overall decision. So the correlation is a positive. The correlation coefficient is a positive one between the two proposed investments, meaning that if one performs badly, then the other will also perform badly, because a positive figure indicates that they are moving in the same direction. So such proposed investment idea of having that kind of diversified portfolio of 2, it will not make any business. It's not going to be viable. It's not going to make economic benefits or sense. So therefore we are not recommending. So we don't recommend that diversification. Reason, because of the positive correlation coefficient of 0.997, which is close to 1, meaning it is a very strong positive correlation. So those are some of the numbers that we have. Maybe the other thing that we can look at, we can also try another simulation, because we are doing very many numbers, because this is an area where you are supposed to maximize the points if at all the examiner brings it. It's a number that doesn't miss, but it's a number where you'll score more marks. The only problem with it is that you will spend more time on it, because if let's say they bring 3 to 4 investment projects and you don't actually know how to do them in a shortest way, you are going to spend a lot of time on this number. It is a very simple number to do, but it consumes time. So we try to do very many numbers to see how you can be able to adapt to any kind of situation the examiner may appear to you. So we look at, let's now look at, I think, October 2021. I think question 4. It's the one that has 3 projects, because we have not done a number that has 3 investment projects. So I want to see if the examiner gives you 3 investment projects and they are calling them portfolios, how do you handle that? So let's now try to read through the question and we see what we can do. So question 4, October 2021. We want to look at these 3 projects and we'll see how we can be able to solve. So let's look at the question without wasting more time. So that's our question 4. If you look at the required, they want us to advise PRC on the above investment projects basing on portfolio theory analysis, 17 marks. Part B, they want us to discuss the role of commercial banks in financial systems of economies like Uganda, 8 marks for sure. There are some questions where you see you just want to pass. They just want you to pass. So we are going to focus on part A. Part A, it's all about the 3 investment projects because we are seeing in the table. Let's first read through the question. Prestige Recreational Center, PRC, was established in Uganda in 2016 to serve as a leisure facility for a wide range of customers, ranging from low-income earners to high-income earners. The facility has become so famous recently on account of its wide range of amenities that attract many customers. Recently, the management resolved to expand this facility by setting up 3 new projects, namely gym, swimming pool, and sauna. Accordingly, management allocated shillings 750 million to finance the proposed projects, with each project set to cost 50% of the capital funds available. That statement looks to be telling you something. They are telling you that the funding 50%. Remember, there are 3 projects, but now here they are telling you the amount they are willing to spend is 750 million, but they are telling you each project is consuming 50%, meaning now if there are 3 projects, there is no way you can say 50%, 50%, 50%. No, meaning they are only going to be 50%. They are only going to be 2 projects. Each is taking 50 and the other is taking 50. But they have given you 3 projects. That's what I've been talking about, that they will limit you because the syllabus limits us on 2 projects. But here in the question we have 3. So let's go ahead and look at what we have. They are continuing to say that management has also projected that the return from each project will depend on the state of the weather in Uganda, with 3 seasons expected to occur, namely summer, winter, and autumn. The respective probabilities and specific returns of individual projects are set out as below. They have given us the seasons, the probability, and the returns in percentages. They have also given us summer, winter, and autumn. They gave us the probabilities. They are telling us to advise. They are telling us to advise PRC on the above investments based on portfolio theory analysis. Even if they don't tell you based on portfolio theory analysis, there is no way you are going to analyze these investment projects, especially when they are 3 and they are doing them concurrently, and you think that you are not going to use portfolio theory. So the assets we have are gym, swimming pool, and sauna. Now, because there are 3 projects and the examiner has told us to use portfolio theory analysis, therefore you need to select which portfolio you are going to give the, like which portfolio is going to give the best results, because there are three investment projects, but we are not going to fund all of them. First of all, they started by restricting beyond the funding. They told you the 50% of the capital funds is going to be allocated to one project, meaning the other is also taking 50%. That's the first restriction. So they want us to look at all these projects and see which one has the best to offer. And in this case, you need to form what we call portfolios, because there is no way you're going to do such a number minus forming the portfolios. Here we don't have the portfolio. We have investment projects more than 2. So what we are going to do, since we are restricting ourselves to only 2 investment projects, then this is going to require us to form what we call portfolios. These portfolios, they are going to be limited to only 2 investment projects. So let's now try to form the investment projects. So we can form them because there are 3: gym, swimming pool, and sauna. So we can say the first portfolio, we can say we are going to have a gym and a swimming pool. But this doesn't mean that in real life we don't have such investments. You can go to a hotel, someone has a hotel, at the same time he has a swimming pool, has a gym, has a sauna. So in real life they appear, but as per the syllabus, we restrict ourselves to only 2. So we can have that as our first one. The second one, we can have a gym and a sauna. Then lastly, we can group a swimming pool and a sauna. Swimming pool and a sauna. So you will see that all the 3 are grouped. You can have a gym and a sauna, you can have a gym and a swimming pool, or you can have a swimming pool and a sauna. Those are the 3 that we can form out of those 3 investment projects. So in the question, we have seen that the total amount of money that is available is 750 million. That is the money that is available for all these projects. But they went ahead to say each portfolio will take 50%, each investment. Remember, we are not investing in only one. We are investing in a gym and a sauna. So this one will take 50% if it is profitable. So we are only going to have only 2 options. Even if there are 3 portfolios that we have formed, we have to select only 2, because the composition is going to be 50-50, the capital that we have. So these compositions, they are the ones that we are going to call our weights. Weight 1 is going to be 50, then weight 2 is also 50. Because you can't do all the 3 projects at once. And it's not that it doesn't exist in the real world, it exists, but as per the syllabus, we are only restricting ourselves to only 2 investment projects or assets. So therefore, here we are starting with single assets, but forming portfolios. We started with the single assets they gave us in the question: gym, sauna, and swimming pool. Then we transformed them into portfolios where we got a gym and a sauna, gym and a swimming pool, then sauna and a swimming pool. These are now the portfolios. Whichever that you pick, it will go as a portfolio, because we are going to be doing 2 projects at the same time. So they want us to make advice. Still, we are going to use correlation coefficient. Still, we are going to use correlation coefficient. That's what we are going to use. So we are going to get the correlation coefficient for each portfolio. Then we select what we are going to execute based basing on the results the different results that we have got from these different computations. So if all the investments are going to give us a negative correlation, in other words, if all these investments are negatively correlated, how are we going to advise? Because you may find that all these investment proposals are all viable. How are you going to conclude? So if that happens and all the investments are going to be good, they are negatively correlated, then we should choose those investment portfolios that are stronger. In other words, they are strong negative correlation. They are strongly negative correlated. In other words, we pick those investments that are close to -1, because we said the maximum is supposed to be 1. So those that are close to -1, they are going to be the ones that we shall select. Because those that are close to -1, they are going to be the ones that are better. They may all be negative, but you find one is -0.4 and the other is -0.6. So you find that this 0.6 is close to 1 and the other 0.4 is close to 0.5, which is a weak negative correlation. So that's the extent that I talked about, that this correlation coefficient gives, which is not found in the convariance. That's why we prefer the correlation coefficient. Now, once you have analyzed that, or once you have understood that, when you're in an exam, you have to make sure that you guide the examiner on which approach you are going to use, or the approach you have used to answer the question. One way is to get the risk and the expected return of each asset or project. And once you have done with that as a single asset, then you begin with the portfolio you have created. So once you get the expected return for each of these assets, then the next thing you are going to do is to get the correlation coefficient for the different portfolios that you have done. So what I'm going to do, let me start with that approach. We are going to use risk and return. Remember, I told you that in any investment, you should be interested in knowing the risks and the returns associated, whether it is a single asset or a portfolio. That's what we looked at. So let's start with the gym project. Let me just call it a letter G. So we are taking it as a single asset. So we start with the season, probability, then return of G, that is gym, then P times RG, that is the expected return, and we get RG minus RG bar. Here we are trying to get the variance here, RG minus RG bar, then this one is squared. So we have summer, winter, autumn. This is 0.4, 0.4, 0.2. This is 16, 20, 14. These are the ones that they gave us, the returns they gave us in the question. The return for project for gym, they were given to us. So we multiply. It is going to be this times this. 0.4 times 16, it's going to be 6.4. 0.4 times 20 is giving you 8. Then 0.2 times 14, it's going to give you 2.8. Once you add to get the total, this will give you 17.2. That 17.2 is what we call the return, expected return for G, for the gym. Then we go to this minus this here, you get 16 minus 17.2. That is going to give you a negative 1.2. 20 minus 17.2, it's going to give you 2.8. Then 14 minus 17.2, it's going to give you negative 3.2. Now we proceed. This one squared. We first square this one. 1.2 squared times 0.4 is going to give you 0.576. 2.8 squared times 0.4 is giving you 3.136. Then negative 3.2 squared times 0.2, it's giving you 2.048. Once you add all those, you will get your variance. Variance for G is going to be 5.776. These are percentages. So you can compute now your standard deviation. It's going to be the square root of 5.76, and this is going to give you a 2.4. All these are in percentages. 2.4. The expected return is 17.2. This one is 2.4. So we'll go to the next project. We'll go to swimming pool. Swimming pool, let me just use SP. You have seasons, you have probability, you have return of SP, we have then expected return, which is probability times the return of the swimming pool. Then we do the same, we are repeating the same thing. RSP, power bar. Then this one is probability of RSP minus expected return RSP of the swimming pool. This one is squared. Then we put all the seasons as they gave to us. Summer, winter, autumn. 0.4, 0.4, 0.2. The return for swimming pool was 25. Here is negative 5. Here is 17. So multiply. This time the probability times the return. 0.4 times 25, that gives you 10. Then 0.4 times 5, that gives you negative 2. This is negative 5 times 0.2. This is 0.2 times 17. It will give you 3.4. Once you add that, you will get 11.4%. This is your return, expected return SP for the swimming pool. Then we proceed where we are computing the risk. Now we look at this return, 25 minus the standard, the expected return of 11.4. So 25 minus 11.4, it is going to give you 13.6. Then negative 5 minus 11.4, it's going to give you negative 16.4. Then 17 minus 11.4, it is giving you 5.6. Then when you come to this last one, we are going to get this squared, 13.6 squared times this probability of 0.4. It is giving you 73.984. Then negative 16.4 squared times 0.4, it's giving you 107.584. 5.6 squared times 0.2, it's giving you 6.272. Now once you sum that, you will get your variance of SP, and this is going to give you 187.84. So once you get the square root of that, it will give you your standard deviation SP, and it's 13.71%. So this one is 13.7, this one is 11.4. We go to the next one. We go to sauna project. We call it S. Put the seasons, put the probability, we put now the returns. for S. We put the probability times the return of S, that will give us the expected return. Then we look at the return of S minus the expected return of S, then probability of RS minus the expected return squared. So we put all the seasons, the probability they gave us 0.4, 0.4, and then 0.2. The returns for sauna, it is 20%, 12%, 15%, and 18%. So we now multiply through 0.4 times 12, that is giving you 4.8. 0.4 times 15, it's giving you 6. Then 0.2 times 18, it is giving you 3.6. Once you sum that, you'll get your return, expected return, as 14.4%. Then we also finalize this. We get this, the return minus the expected return. So it is 12 minus 14.2. It is giving you negative 2.4. Then 15 minus 14.4. It is giving you positive 0.6. Then 18 minus 14.4. It's giving us a 3.6. So now we get this negative 2.4 squared times 0.4. That will give you 2.304. 0.6 squared times the 0.4, because we are getting this times this. We are getting this squared times this. This is giving you 0.144. Then 36 squared times 0.2 is giving you 2.592. Once you sum all these, you get your variance of S as 5.04. So we get our standard deviation. We get our standard deviation as the square root of 5.04. This is giving us 2.24%. So I've gotten the risk and then the return for each of the investment projects as single assets. Now what we are going to do, we are only going to do, I think, one portfolio. Then the rest you will be able to catch up. At least I've given you how you can be able to do that. So let me show you how to do one portfolio. Then you will be able to do the rest, because I've given you how to conclude and I've given you how you can be able to do the computations. So we are going to only do one portfolio, and the other you'll be able to complete at your own time. So let's look at maybe a gym and a swimming pool portfolio, so that we can be able to compute the correlation coefficient. So we are going for a gym and a swimming pool. That is a portfolio that we are going to look at. So remember our formulas. We are going, this is G and S, SP, gym and swimming pool. So this is G, then SP. Standard, the correlation coefficient is equivalent to the convariance of gym and then is the swimming pool over standard deviation of the gym times the standard deviation of the swimming pool. But we said the convariance of the gym and the swimming pool are actually given by summation P into the return of G, that is the gym, minus expected return of G, into the return of the swimming pool minus the expected return of the swimming pool. So we have to first compute this convariance first, then we'll be able to do the rest. So let's draw the table. So we start with the seasons, then probability, then we need return of G minus expected return of G of the gym. Then we need the return of the swimming pool minus the expected return of the swimming pool. Then lastly, we need this probability when we are multiplying these two into RG minus RG bar. So that's what we need. They are all in percentages. Summer, winter, then autumn. This is 0.4, 0.4, 0.2. This one you pick it from the return that we computed when we are computing the one for gym. This was negative 1.2. This was 2.8. This was negative 3.2. And the one for this was 13.6. This is negative 16.4. And this is 5.6. So we multiply. We first multiply this times this, then after we multiply by the percentage. So this is giving us negative 6.528. This one is giving us negative 18.368. This one is giving us negative 3.584. Once you add this all together, you get the convariance of G and SP, the swimming pool, which is a negative 28.48. All these are percentages. So you can see the good thing that you have a negative, it means the investments are okay. They are good investments. But we have to make sure that we complete everything to know which one is going to give us. So you repeat the same thing, you just pick the one you pick the other set of portfolio, you compare, then you do what you call the convariance. So we can put, since we have gotten this, we now go and compute the convariance, the correlation coefficient of a gym and the swimming pool. Remember the other one we got, it is the convariance is 28, it is negative 28.48. These are all percentages over, then we pick the standard deviation for this. The standard deviation for gym, was 2.4 times the one for Sauna, which was 13.7. All these are percentages. So when you work out that with the calculator, you'll find that you have a negative 0.87. That's what you do for all. So we have gotten this. This one is, it is a strong because it is close. It is close to negative 1. So you compute the rest and you see how you can be able to comment on that. So basically that's what I wanted to make sure you understand before we go to what we call the CAPM, which is capital asset pricing model. Because if you don't understand the other portfolio theory, this one has something to do with the portfolio theory and it will confuse you. Even because if you don't understand this portfolio theory, CAPM will be a challenge to you. And if CAPM is a challenge to you, it means even the NPV is going to be a problem to you. Even when you are computing the risk-adjusted cost of capital, they are also going to be a problem to you. So it is better you understand these things. Do as many numbers as possible for you to be able to understand to understand portfolio theory so that you can improve your chances of understanding these other aspects, because this is where this is the most important part as far as advanced financial management is concerned. Because if you don't understand CAPM, because most of these other formulas for computing the cost of equity, we did them on level 2. It's only the CAPM that was missing. So that's why I've tried to make sure that we get all that we need as far as portfolio theory is concerned. We know that by the time we reach CAPM, we will be able to get these aspects. Or we shall also get numbers that have CAPM and also have portfolio theory mixed together to test our understanding.